I know how tough it is to study and how frustrating it can be and confusing to study the vocabulary words for your life insurance exam. In this video, I am going to be breaking down every single vocabulary word that you will need to know for your life insurance exam. So let's get right into it so I can help you clarify these terms and get you to passing your exam on the first try.
So the actuarial department. This is the team in charge of determining insurance policy rates, calculating reserves. Reserves is how much money the insurance company has in reserve, right? It's like their piggy bank. And determining dividend payout. So dividends are essentially profits that the insurance company makes that they pay out to their policy owners. Thought I broke my thing. Can't break this. My Guinevere, if you can see it. I don't know, but anyways. So the actuarial department, they are the math wizards of policy pricing. That's the way that I learned it. So math wizards of policy pricing, if you want to write that down. They essentially figure out how much policies are going to cost. So they calculate rates. So an example is before launching a new life insurance policy, the actuarial department calculates the policy rates based on life expectancy and health data. So they also determine the reserves needed to pay future claims and estimate potential dividends for policyholders. So they ensure that the policy is priced correctly, financially secure. So actuaries, that's what they're called, the people who are part of the actuarial department, they are hired by the insurance carriers to calculate rates and figure out what they should charge for the policies and what someone should have to pay for their policy depending on the risk that they pose to the insurance company. So they are the math wizards of policy pricing. Next, alien insurer. In the context of the United States, so here, an alien insurer is a company that operates in the U.S. but has its main office and legal base in another country. So there's a few types of insurers. There's going to be alien, foreign, domestic. I'm going through these in ABC order here. Based on each chapter in the course that I've created, part of my 4 core insurance mastery framework. So example, a life insurance company based in Germany decides to offer policies in the United States. Although it operates in the U.S., its main office and legal base remain in Germany. In this case, the company is considered an alien insurer in the U.S. because it's headquartered in another country while conducting business in the American market. So they have a foreign home, but they have a local business. So an alien insurer is a company that operates in the U.S. but has its main office in another country. A foreign insurer is a company that has its main office, and we'll get to this in a minute, but it has its main office in the United States, but it's conducting business in another state. So a foreign insurer would be like the main office is in Texas, but they are conducting business in Massachusetts. And then a domestic insurer would be a company that's conducting business in Massachusetts and has its home office in Massachusetts. So domestic, home office and business conducted in the same state. Foreign, different state home office than where the state where the business is conducted. And then alien insurer has the home office in a different country, but they're conducting business in the United States. Next, admitted insurer. So an admitted or authorized insurer is a company that's been officially licensed. They've been given a certificate of authority by a state's insurance department permitting them to sell insurance within that state. So what I like to say is state approved, ready to move. So they're state approved, they're ready to move, meaning they can sell insurance, they can move policies. So an admitted insurer is state approved, ready to move. An example, a life insurance company wants to sell policies in California. To do so legally, they apply and receive a certificate of authority from California's Department of Insurance. With this certification, the company is recognized as an admitted insurer in California, meaning they are authorized to conduct insurance business within the state. So they have been admitted to the club to sell insurance. Broker. A broker works independently, representing their own interests and those of their client or customer. So a broker Client is how I memorized broker was client first, company last. So broker is client first, company last. So brokers represent the clients first, and then they look for the interest of the company. So a broker, really what they do is they try to look to see which company is going to offer the best pricing to their customers and really the best program for that customer's specific need, because they work with a bunch of different carriers and they work independently. So a person is looking for the best life insurance policy to fit their needs. They hire a broker who works independently, representing the client's interests rather than any specific insurance company. The broker researches various policies from different insurance companies and helps the client choose the best option, ensuring that the coverage meets the client's requirements. So this can be challenging, though, because sometimes when you get into the business, there are brokers who have access to certain companies, but then there are some companies that don't hire brokers that have their own products that are really, really good. So, it's subject to debate because the cheapest policy is not always the best. I want you guys to understand this getting into the business. The cheapest policy is not always the best policy for your customer. You may ask, Justin, why is that? Well, it's because not every company is created equal, right? So if I can save $20 a month on a policy, but their customer service is terrible, can't get in touch with anybody anytime I call, they bill me on the wrong date, they make all types of mistakes, then is it really worth saving money? So these are things that when you get into selling, you want to take into consideration. And also too, the less someone pays, the less money you make. So sometimes you have to find a balance between you making money and you getting the client a good policy, because at the end of the day, you can only serve your customers if you're in business. And if you don't make enough money, you're not in business, right? So there's a balance there. That's my personal opinion, having made millions of dollars selling insurance and I have thousands of happy clients. So captive insurer is an insurance company that are formed and owned by a parent organization with the purpose of insuring the risks of the parent company. Okay? So example, a large manufacturing company faces significant risks due to potential accidents and equipment damage. To manage these risks more effectively, the company creates its own insurance subsidiary, which is solely responsible for covering the company's losses. This insurance subsidiary is known as a captive insurer because it was established and is owned by the parent company specifically to insure its own risks. Okay, so a captive insurer is a company that was created just to handle the insurance risks of the company that created it. So parent-owned risks at home. So what I want you to think of is captive insurer is parent-owned risks at home. So think of like a captive insurer almost being like a home, right? So your parents own it, and it covers the risks that happen at home, right? So it's created by a company to insure its own risks. Certificate of authority. So we covered this just a little bit ago when we were talking about authorized or admitted insurers. But a certificate of authority is a formal license provided by a state's insurance department that allows an insurance company to operate legally in that state. Example, before a life insurance company can start selling policies in Texas, it must obtain a certificate of authority from the Texas Department of Insurance. This license legally authorizes the company to conduct insurance business within the state, ensuring that the company meets all regulatory requirements and can operate as an admitted insurer, another vocabulary word, in Texas. So for certificate of authority, I look at it as a license to sell. It's official permission to sell insurance in a state. Certificate of authority is an official permission to sell insurance in a state. Claims department. This is the department responsible for handling the processing, investigation, and payment of insurance claims. So they process, they investigate, and they pay the fate. I know it's corny, but yeah. Process, investigate, and pay the fate. So they handle insurance claims from start to finish, the claims department. So when a policyholder files a claim for a life insurance payout, the claims department steps in to handle the process. They begin by reviewing the claim details, investigating to verify the validity of the claim, and ensuring that all required documentation is provided. Once everything is in order, the department processes the claim and arranges for the payment to be made to the beneficiaries, ensuring that the policyholder's obligations are met according to the terms of the insurance policy. So the claims department, essentially someone submits a claim and they just make sure that the claim is valid and that it can be paid, and they figure out where to pay it and everything else. So if this is helping you, then please click the link in the description of the video for a copy of my free study guide. And also email me if you're interested in working with me selling insurance. Divisible surplus. Divisible surplus. So this term refers to the portion of an insurance company's earnings that's distributed to policy owners as dividends after the company allocates funds for reserves, operational costs, and other business needs. So example, at the end of the year, a life insurance company reviews its financial performance and determines that it has earned more than expected. After setting aside the necessary funds for reserves, covering operating expenses, and meeting other business obligations, the remaining amount is considered the divisible surplus. This surplus is then distributed to policy owners as dividends, providing them with a share of the company's excess earnings. So, divisible surplus is essentially a company's earnings distributed to policyholders as dividends. So it's essentially like after they put money aside for extra savings, after they cover their operational costs, claims, other business needs, everything else, the divisible surplus is how much money is left over that they can spread amongst the policy owners to give back as a dividend. Now, not every company pays dividends to its policy owners. So these are mutual insurance carriers, which we'll learn in a bit here. Mutual life insurance carriers pay dividends to their policyholders. Okay. So these are earnings shared after care. That's the way I looked at divisible surplus. That's how I memorized it. Earnings shared after care. So it's the earnings they share after caring for the other parts of the business. So after everything in the business is handled, these are the earnings. Okay. Domestic insurer. So we are moving through here. We're on page 2 of 8. And then we get a whole, this is going to be a long series, guys. But this is everything you'll need to know for at least the general content in your insurance exam. So domestic insurer is an insurance company that operates in the state where its main home office is located and where it is authorized to do business. Okay. Example, a life insurance company based in New York with its principal office located in New York operates primarily within New York. Because its main office is in New York and it's authorized to conduct insurance business there, the company is considered a domestic insurer in that state. So domestic insurer is home sweet home. They operate in the state where it's based. Okay? Domestic, home. Domestic has to do with home. So that's how I remembered it for the insurance exam. Domestic has to do with home, and it's an insurance company that conducts business where its home state is. Foreign insurer. This is an insurance company that conducts business in a state other than the one where its principal office or legal base is situated. Example, a life insurance company has its principal office in Florida, but also sells policies in Georgia. Since the company is based in Florida but conducts insurance business in Georgia, it's considered a foreign insurer in Georgia. So I know a lot of times we think foreign as people from another country, but you need to think like someone is an alien from another country, right? Think about like, I don't mean to bring it to politics, but people are, legal or illegal aliens, right? It's like a big thing now. So alien, think of in that context, right? Okay, someone's from another country. If an insurance company is in another country, but they can't sell insurance in the U.S., that's an illegal alien insurance company, right? Just kind of think of it that way. I hate to bring it there to politics, and this isn't to share any opinions or anything on it at all. And I whatever people want to think or believe, that's totally cool. But this is just to help pass for the exam, okay? So foreign insurers, you think that foreign would be in another country, but foreign's really another state if principal office is in one state. So foreign, I really look at it as like their next door. If your neighbor's state is selling insurance in your state, then they are a foreign insurer. Fraternal Benefit Society. So Fraternal Benefit Society is a non-profit organization that offers insurance coverage exclusively to its members within a fraternal or benevolent framework. Okay? And benevolent, just so I can clarify that definition for you, it's well-meaning and kindly. It's serving a charitable rather than a profit-making purpose. So benevolent, if you're going through any of your course material, guys, and you see big words, it's because you want to look up the definitions, but sometimes they just have to make them wordy. Okay. Next, a Fraternal Benefit Society. So the way I remembered it was members unite for insurance might. Members unite for insurance might. So it's a society where the members unite for insurance might. It's a nonprofit offering insurance to its members. Next, industrial insurer. Okay. A specialized segment of the insurance industry that issues policies with small face amounts and collects premiums on a weekly basis. They are known as home service or debit insurers. These are not a big thing anymore. But they'll typically offer life insurance. So right here, a company offers life insurance policies with small face amounts, such as $1,000 or $5,000, and collects premiums from policyholders on a weekly basis. These policies are designed to be affordable and accessible, often sold directly to individuals in their homes by agents. This company operates as an industrial insurer, also known as a home service or debit insurer, catering to clients who prefer manageable, frequent payments for smaller insurance coverage. So these were mainly designed to cover people's funerals and burials. So small policies, weekly collections. So that's how I remembered it. Small policies, weekly collections. So they would sell small policies and collect money every week. Okay, so insurance is the process of managing risk by pooling resources or accumulating funds to cover potential losses. Okay, so insurance is simply the sharing of risk. Very simple definition. It's when you pool resources to cover potential losses. When someone buys insurance, it's because they can't afford to assume the risk if something happens, right? Like people get life insurance because they say, hey, my family can't afford for me to die tomorrow. People get health insurance because they say, hey, if I get injured or really sick, I can't afford to go to the hospital. Someone buys car insurance because they say, hey, if I get in a car crash, I can't afford to fix that car and pay that person's hospital bills. So insurance is when people pool their risks together so that the claims can be covered. Okay? So a group of individuals each pays a small amount into a shared fund every month. This is just breaking it down super general. A group of individuals pays a small amount into a shared fund every month. If one member experiences a significant loss, such as damage to their property or a health emergency, the fund is used to cover the costs. This system represents insurance, where risk is transferred from individuals to the group by pooling funds, ensuring that no one person bears the full burden of a large unexpected expense. Okay, so sharing the load when risks explode. That's one way that I would remember it is it's the sharing of risk, but sharing the load when risks explode. Okay. So the insured is the individual or entity that receives insurance coverage under the policy. So it's the person who the insurance is for. Example, John purchases a life insurance policy to provide financial security to his family. In this scenario, John is the insured, as he is the customer receiving protection under the insurance policy. Something happens to him, the insurance company will pay the benefits to his designated beneficiaries. Okay. So it's the covered person. The insured is the covered person. The insurer is the company that provides the insurance coverage. So when John bought that policy, the company that issued the policy and agrees to pay out the benefits in the event of his death is the insurer. This company is responsible for providing the insurance coverage and managing the risks associated with the policy. So Lloyd's of London. This is not an insurance company, but it's a marketplace where individuals and companies come together to underwrite unique or unusual insurance risks. So Lloyd's of London is essentially it's a marketplace where unusual risks are underwritten. So it's a marketplace for rare risk. That's the way I looked at it. Marketplace for rare risk. It's pretty unique. So once you kind of understand what it is, it's hard to not remember it. But it's example, a movie production company wants to insure its lead actor against the risk of injury during filming, a unique and high-risk scenario. Instead of going to a traditional insurance company, they approach Lloyd's of London, which is not an insurer, but a marketplace where individual underwriters and companies come together to underwrite unusual or complex insurance risks. The underwriters at Lloyd's agree to cover the actor's insurance, pooling their resources to manage this specific and uncommon risk. So an example, like Adele, I think her voice is insured. A lot of artists, like super famous artists, will get their voices insured. So part of the reason sometimes you might see some big musicians like cancel shows, it's because if their voice is strained and they get checked up on by a doctor, then Lloyd's of London could say, hey, look, if this doctor says you shouldn't perform and you do and you hurt your voice, we're not covering you. So I think like this could be a total rumor, but I think some actors get like body parts covered too if they need it covered for whatever reason. So Lloyd's of London, I think, will do that too. So they cover like rare risks associated with stuff like that. Maybe just an idea. I don't know if this one is really something covered by Lloyd's, but thinking like a surgeon might get his hand insured, right? Because if something happens to his hand, he can't work. Okay, multi-line insurer, all in one, every coverage under the sun. So multi-line insurer, all in one, every coverage under the sun. They offer a variety of insurance products. So this is an insurance company or independent agent that offers a wide range of insurance products, allowing businesses or individuals to address all their coverage needs in one place. For example, they might cover home, life, auto, long-term care, and health insurance. So a multi-line insurer is like a one-stop shop for you to go to get all your insurance. Now, a family wants to simplify their insurance coverage by having all their policies with one company. So they contact a multi-line insurer that offers a variety of insurance products, including their auto, home, life, and health insurance. By choosing this insurer, the family can manage all their insurance needs in one place, benefiting from the convenience and potentially qualifying for discounts for bundling multiple policies together. So a multi-line insurance company is like a one-stop shop. They sell all the types of insurance that you want, so you can go there and get all the insurance and not have to worry about going anywhere else. Okay, next, mutual insurance company. So these companies are owned by policyholders rather than stockholders, and they have no capital stock, meaning the company does not issue stock shares to the public or to private investors. They typically issue participating policies, meaning policyholders may receive dividends. So they don't have any stock. So a mutual insurance company, okay, policyholders own it, and policyholders own, dividends known. That's how I remember it. So the policyholders own the mutual insurance company. So it's owned by the policyholders. In a stock company, the company is owned by stockholders. Okay? So these typically issue participating policies because a stock company has to worry about paying profits to its stockholders, right, in Wall Street. But a mutual insurance company can pay its profits to its owning members. So you might say, why would someone go stock then versus mutual? Well, in general, this isn't always the case, but in general, and this is not sales advice, this is just what I've seen. In general, mutual insurance companies charge more for their premiums for a certain amount of coverage than stock companies. So if there's someone who's, in certain situations, in mutual insurance companies can sometimes be harder to qualify for, and they'll charge more. So if someone has, that's just what I've noticed. Example, Sarah purchases a life insurance policy from a mutual insurance company. Unlike stock companies, this company is owned by its policyholders, including Sarah. Because it's a mutual company, Sarah may receive dividends if the company performs well, which can be used to reduce her premiums or increase her policy's value. She may also be able to participate in the election of members of the board of directors. As a policyholder, she effectively shares in the ownership and profits of the company. So when someone has a mutual insurance company, if that's what their policy's with, then they essentially own part of the company. Actually, for this video, I'm just going to go over the vocabulary words, and then the notes I'll go through in another video. But it's the notes are kind of just like the vocabulary words talked about in a different way, because all of these vocab words are covered in the actual courses too. So, adhesion. Okay, we're going to talk about a contract of adhesion. This is a contract created by one party, typically the insurance company, with no opportunity for negotiation by the applicant. Okay? The applicant must accept the terms as they are on a take it or leave it basis. So adhesion is a take it or leave it. You can adhere to the rule or you can't. It's a one-sided thing. Okay, so adhesion, take it or leave it. Example, when Michael applies for a life insurance policy, with adhesion, there's no negotiation. The terms are set by the insurance company. So when Michael applies for a life insurance policy, he's presented with a pre-drafted contract by the insurance company. He cannot negotiate the terms or make any changes. He must either accept the policy as it is or decline it. This is an example of a contract of adhesion, where the terms are set by the insurer and the applicant adheres to take them on a take it or leave it basis. So pretty straightforward. Adhesion, take it or leave it. These are the rule. This is the deal. Do you want it or not? So an agent represents both themselves and the insurer during the application process. Remember, a broker represents themselves and the client during the application process. So an agent, we'll get that in a second, but when Susan meets with a life insurance agent to apply for a policy, the agent represents both the insurance company and themselves as a licensed professional. While the agent provides information and guidance on behalf of the insurer, they also act within their own capacity, ensuring that Susan's needs are met and that the application process is handled correctly from both the company's and their own professional perspective. So, in this sense of the word, they're saying that an agent has a limited amount of products that they sell, and they'll sell for essentially one company and just represent that company. So they can be an agent for a company. Okay. Now, aleatory. An aleatory contract involves a potential imbalance in value exchanged between the parties. Okay. So an aleatory, it's unequal exchanged based on chance. So there's an uneven value exchange depending on an event. So we'll look at the example and I'll go into it a little bit more. But John purchases a life insurance policy and pays regular premiums. If John passed away shortly after the policy is issued, the insurer will pay out a large death benefit to his beneficiaries, even though John only paid a few premiums. This is an example of aleatory contract where the exchange of value may be unequal and depends on the occurrence of an uncertain event, like John's death. So aleatory, you want to remember as an unequal exchange of value. Okay, unequal exchange of value. So obviously, like John's premium is going to be a lot lower than the death benefit that his beneficiary will receive when he dies. So there's the potential for a massively unequal exchange of value. John can make one payment, and then that entire large death benefit pays out. So aleatory is unequal exchange of value. Apparent authority. Apparent authority refers to the situation where it appears that the insurer has given the agent authority to perform certain tasks, even if those tasks are not explicitly stated, based on the relationship between the agent and the insurer. So as an example, Sarah, who's an insurance agent, helps a client to make changes in their life insurance policy, even though the insurer has not explicitly granted her authority to make such adjustments. Because Sarah regularly represents the company and interacts with clients, the client reasonably believes that she has the authority to make these changes. So this belief is based on apparent authority, where the insurer's relationship with the agent gives the appearance that the agent has the power to perform certain tasks, even if they aren't specifically authorized. So apparent authority is like, well, you are an insurance agent, so it's the parent authority is that you can do things like help me change my policy. Okay. Broker. A broker represents both themselves and the client during the application process. Mark, who's looking for the best life insurance policy for his needs, is looking for the best life insurance policy for his needs. So he works with a broker who's not tied to any particular insurance company. So by this sense of the word, previously, agent is tied to a particular insurance company. They represent themselves and Mark, or the insured, throughout the process. The broker researches various options across multiple insurers to find the best policy for Mark, ensuring that his treatments or his interests are the priority. I'm going to back up to apparent authority here. I was always kind of confused on these, like authority, so just do your best to learn it. Apparent authority is, it looks like power even without the tower, I guess, the way you want to look at it. So the agent appears to have the authority even if it's not explicitly given. All right. Remember, guys, check out the description of the video for a copy of my free study guide and my email. Okay. So competent party is one who has the capacity to understand the contract they're entering into. All parties must be legally competent, which means they should be of legal age, mentally fit, and not impaired by drugs or alcohol. So part of a legal contract means that the people involved must be a competent party. So they have to be of age, which varies from state to state. Usually it's like 18. I think Florida, you can be 15 for life insurance. Every state's different, so just look up what it is in your state. They have to be mentally fit, meaning they can't have like mental conditions that would prevent them from being able to make a smart decision. And then they can't be impaired by drugs or alcohol, so they can't be under the influence of drugs. So Jane, here in the example, a 35-year-old professional, applies for a life insurance policy. Since she is of legal age, mentally sound, and not under the influence of any substances, she's considered a competent party. This means she is fully capable of understanding the terms of the insurance contract and legally agreeing to them, making the contract valid and enforceable. Concealment occurs when an applicant fails to disclose a material fact that they know when applying for insurance. So concealment, it's pretty straightforward. You're trying to conceal a fact, right? So concealment in insurance is when you are trying to withhold information that might impact underwriting. So we'll give an example here. Tom fails to disclose that he was diagnosed with a heart condition a year ago, even though he's aware that this information is relevant to the insurer's decision. This omission is considered concealment, as Tom knowingly withheld a material fact that could affect the insurer's risk assessment and the terms of the policy. If it's discovered, this concealment could lead to the denial of his claim or cancellation of the policy altogether. So concealment in some states is illegal as well. Conditional. So a conditional policy is one in which the insurer's obligation to pay benefits is dependent upon the occurrence of a specific event that the contract covers. Example, Maria purchases a life insurance policy, and the insurer promises to pay the death benefit to her beneficiaries. However, this promise is conditional. The insurer will only pay if Maria passes away while the policy is active. For the policy to remain active, Maria must continue paying her premiums on time and comply with any other terms of the policy. If she fails to meet these conditions, such as missing payments, the insurer may not be obligated to pay the death benefit. So this is where the insurance company is obligated to pay benefits only under a specific situation or events. Okay, so it's they will pay on the condition that something happens. Okay, consideration. Consideration is the part of an insurance contract that specifies the details regarding the initial and renewal premiums, including the timing and frequency of future payments. So the consideration is essentially the application that the insurance that the application, the insurance client, sorry, brain fart here, the application that the proposed insured is giving, plus the information on their premium. So how much is the premium and how frequent are the payments? So a way to think of consideration is that here is my application and my payments. Will you consider me for insurance? Okay. So the proposed insured is asking for the insurance company, to consider him for insurance with his application and his proposal to pay premiums. So example, when John purchases a life insurance policy, he agrees to pay an initial premium of $100, followed by monthly renewal premiums of $50. This agreement to make these payments is the consideration on John's part. Usually, the initial premium is the same as the monthly. In return, the insurance company promises to provide coverage and pay a death benefit to its beneficiaries if the terms of the policy are met. The premiums and payment frequency form the basis of the consideration. So the premiums and the payment frequency. Applicant. The applicants offered a completed application in the initial premium as consideration to the insurer in return for insurance coverage. So that's it. The completed application and the initial premium is the consideration. So Sarah is an applicant for a life insurance policy. She submits a completed application along with the initial premium payment. As the applicant, Sarah is the person seeking insurance coverage, and her information will be reviewed by the insurer to determine if she qualifies for the policy. Okay. Estoppel. Estoppel is a legal principle that prevents a party from going back on their previous actions. Can't go back. It prevents them from going back on previous actions, statements, or conduct if such behavior led another party to rely on it and take action accordingly. So an example, if an insurance company, through its actions or communications, leads a policyholder to believe they are covered for a certain claim, and the policyholder acts based on that belief, the insurer cannot later deny coverage for that claim due to the insurance company's previous conduct. Okay? So this prevents someone from reversing their actions if another party relied on them. Express authority. This is the authority explicitly given to an agent, clearly outlined in the agency contract. Example, David, an insurance agent, has a contract with an insurance company that specifically outlines his duties, including the authority to collect premiums and issue temporary insurance binders. This is known as express authority, as it's explicitly granted to David by the insurer and written in his contract, clearly defining what tasks he's authorized to perform on behalf of the company. So it says David is allowed to collect premiums on behalf of the company. So express authority is something that's explicitly given or authorized to the insurance agent in their contract with the carrier. Fiduciary. Fiduciary. This is the obligation of an insurance producer to manage collected premiums responsibly and to provide clients with sound financial advice. A fiduciary holds a position of trust concerning the management of their clients and the insurer's funds. So, an example, a fiduciary means you have a financial responsibility to act in the best interest of your clients. Okay? So, an example, an insurance agent, Emma, collects premiums from her clients and ensures that these premiums are promptly submitted to the insurance company. She's also responsible for giving her clients sound financial advice regarding their insurance needs. In this role, Emma acts as a fiduciary, meaning she's in a position of trust both with the insurer and her clients, and must manage their funds and provide advice with care and integrity. So fiduciary is trusted with money. Okay? Express authority, here we have written permission. That's written permission. Okay? All right. Fraud. Lying for gain. This is when you give false information to cheat the insurance company. This is the intentional act of providing false information or making deceptive statements to receive compensation from an insurance company. Example, Tom, poor Tom. Tom intentionally lies on his life insurance application, claiming he's never smoked. even though he is a regular smoker. He does this to receive a lower premium. This act is considered fraud because Tom deliberately provided false information to deceive the insurance company with the intent to gain financial advantage through lower insurance costs. If discovered, this could result in the denial of his claim or cancellation of the policy. So fraud is when you lie to gain. Implied authority. This is the authority that is not explicitly stated in the contract but is assumed to be necessary for the agent to perform their duties. So this is unspoken permission. These are the powers needed to do their job even if they're not written down. So Sarah's agency contract does not specifically state that she can schedule medical exams for clients applying for life insurance, but it is considered part of her role as an agent to facilitate the application process. This is an example of implied authority, where even though the task isn't explicitly written in her contract, it's understood as necessary for her to carry out her routine responsibilities as an insurance agent. So I'm going to look up so I can find this here. A different way to because I want to make sure you guys understand the difference between apparent and implied authority, okay? So apparent authority is when a third party believes the partner is authorized to take action. Implied authority is when partner does acts necessary to do something he has authority to do but is not specifically stated. Here. Implied is like the partnership, in fact, did imply that he had the authority to do this thing. Like it was implied as part of his job that he could do something. But apparent is like he doesn't actually have authority to do it. It's about what a third party thinks. A third party perceives him as apparently having authority. Okay. So implied is something that they do. Apparent is something that someone perceives that they can do. Okay, so it's apparent that the agent can help me change my policy. The agent actually can't always help someone change their policy, but you'd think that, a client would obviously, a lot of times the agent can't. The insurance carrier has to do it, but the insured would assume it's apparent that the agent could do it. I get calls all the time to ask people to make changes. There are people asking to make changes. Okay. So it's implied authority that Sarah can call to make these medical exams for clients. That's not a huge part of the exam, but, it is something that you want to learn. All right. Indemnity contract. This is a type of contract that aims to restore the insured to their financial position prior to a loss. So a life insurance policy typically functions as an indemnity contract when it includes a return of premium rider. In this case, if the policyholder outlives a policy term, the insurance company provides the return of premiums paid over the term, restoring the policyholder's financial position to where it was before they entered the contract. But life insurance policies are typically valued contracts, which is a specific value. They're not normally indemnity contracts, which we will learn about in just a little bit. But that rider brings it to an indemnity contract state. Okay, insurable interest. Insurable interest refers to the economic, emotional, and financial consequences that arise if a person suffers a particular loss. A person has an insurable interest in a loss if they would benefit financially or otherwise by avoiding that loss. So insurable interest means that someone is they're going to suffer a loss economically, emotionally, or financially if someone suffers a loss. So, there has to be insurable interest and a legitimate reason to get a life insurance policy on someone. You can't just go get a life insurance policy on anybody you want. Example here, Mary purchases a life insurance policy on her spouse as she would face significant financial hardship if her spouse were to pass away. Because Mary relies on her spouse's income and emotional support, she has an insurable interest in her spouse's life. This means that she stands to lose more if her spouse passes away, so she benefits more from their continued well-being. Now, I don't want you to think that you can have emotional interest, insurable interest in someone who's like famous just because you like them. Like if you'd be sad if your favorite actor died, that doesn't mean you can get life insurance on them because they're not really providing some support day to day that the insurance company would think you would have trouble living without. I mean, some people might be extreme fans, but that's life insurance companies don't really roll that way. Okay, so an insurance policy is a written agreement in which one party promises to compensate another for losses arising from unforeseen events. Okay? So an insurance policy, one party compensates another for losses arising from unforeseen events. So example, a life insurance policy states that the insurance company will pay a death benefit to the policyholder's designated beneficiary upon the policyholder's death. In return, the policyholder agrees to pay regular premiums to maintain the coverage, ensuring financial protection for their loved ones. Okay? So the agreement is that if someone dies, the insurance company will pay out the money as long as the client has made their premium payments. Hey, legal purpose. So this is a requirement in an insurance contract that the contract must be for a lawful purpose and not contradict public policy. So you can't take it out for an illegal reason. So example, an individual cannot take out a life insurance policy on a stranger without their consent or a valid insurable interest, as this would violate the legal purpose requirement. The policy must serve a lawful purpose, such as providing financial protection for a family member or business partner, to be enforceable. So you can't get a life insurance policy out on something that's illegal or without someone's consent, or like, if you can't use it to cover anything illegal. Like it has to have a legal purpose. I hope that. I mean, that's pretty self-explanatory, I think. Okay. So material misrepresentation. So these are big lies that that affects decisions. So a material misrepresentation is a misleading statement made by an applicant that may impact the insurer's judgment on whether to take on the risk. So when applying for life insurance, Robert claims he's never been diagnosed with a chronic illness, even though he has a history of heart disease. This is a material misrepresentation because the false statement significantly affects the insurer's decision-making process. If the insurer had known the truth, they may have declined the policy or charged a higher premium. This misrepresentation can lead to the policy being voided or claims being denied if discovered, because this is sort of like a fraudulent thing, right? So essentially, you can't lie. A material misrepresentation is a lie on an application. Okay, parole evidence rule. The parole evidence rule stipulates that once parties have put their agreement in writing, any previous verbal statements are included in that written document, and a written contract cannot be altered or amended by oral evidence. So this is saying that like once everything's in writing, that's it. That's what it is. John and the insurance company. So only what's written in the contract counts in a parole evidence rule. So only what's evident in the written evidence in the contract counts, not verbal promises. So John and the insurance company agree on the terms of his life insurance policy, and everything's documented in the written contract. Later, John claims that during their initial conversations, the agent promised an additional benefit not included in the policy. However, under the parole evidence rule, John cannot use this oral statement to modify or add to the terms of the written contract. Only what's clearly stated in the written agreement is legally binding. So parole evidence rule, what's written ends up being the rule. Parole evidence rule, what's written ends up being the rule. Policy rider or endorsement. We're going to get into a lot of these later on, but a policy rider or endorsement is an amendment to an insurance policy that modifies the original terms, which could add or remove coverage or adjust other policy features. So it's like an adjustment. It's a feature. It's a manipulation. Example, a life insurance policyholder adds a waiver of premium rider, which ensures that if they become disabled and cannot work, the insurance company will waive their premiums while keeping the policy in force. So a policy rider or endorsement is an addition to a policy that could add, but it could also subtract. Okay, so for instance, say someone applies for a life insurance benefit, but they take on risky activities. The insurance carrier may, say the insured wants to add the accidental death benefit rider, which would double the benefit if they pass away on accident. Then the insurance company may provide an endorsement saying they will not qualify for the accidental death benefit rider because of how risky their activities are. Man, it is lightning and thundering out like crazy. I hope I don't get hit. Okay, reasonable expectations. The concept that the insured should receive coverage that a sensible and judicious person would expect from the policy. So this is just saying like, so for instance, it's what's fair to expect. So you should get the coverage that a normal person would expect to get. Example, a policyholder purchases a term life insurance policy and names their spouse as the beneficiary. The policyholder passes away unexpectedly during the policy's term. Although the policy contains complex language regarding exclusions, under the principle of reasonable expectations, the beneficiary expects and is entitled to the death benefit because a reasonable person would assume the policy covers death during the active term of the policy. So the reasonable expectation for life insurance is, hey, if someone dies while they have the policy, the payout, the death benefit will pay out. Okay, representations. Representations are statements made that are believed to be correct and truthful to the best of their knowledge. Statements made by the applicant. So example, when applying for a life insurance policy, the applicant states on the application that they do not smoke based on their belief in understanding that they have not smoked in the past 5 years. This statement is a representation. If later discovered that the applicant had smoked within the past year, it could affect the validity of the policy, but only if the misrepresentation is deemed material to the risk. So, for instance, like if someone's like, hey, I haven't smoked in the last 5 years, and they literally forgot, and then somehow it came up that they did smoke, then that would be, that's a representation is something we believe to be true to the best of our knowledge and belief. So it's like, I don't think I have cancer, but something could happen. You do. I guess the smoking one there's a bad example, but it could be like, hey, I don't believe I have cancer, but I very well could, but I don't know. I believe I don't right now. So that's a representation. Whereas a warranty, which we'll get into in a second, but that's a statement that's guaranteed to be true. Like, I am Justin von Meigen. That's a warranty. I'm guaranteeing that to be true. Subrogation is the insurer's right to seek reimbursement from a third party responsible for causing a loss to the insured. Example. Subrogation is generally does not apply to life insurance. It's more common in health or property insurance, where the insurer pays for losses and then seeks reimbursement from the third party responsible for the damage or injury. For instance, if a health insurer pays medical bills after an accident caused by another driver, the insurer may use subrogation to recover those costs from the at-fault party's auto insurance. So subrogation is when the insurance company chases down a third party for a loss. Like, I don't know about property and casualty insurance that much yet, but say someone goes and burns down a building. So like, oh, I want to burn my neighbor's house down. I wouldn't do that, obviously, but say someone did. House burns down, and then the insurance company finds out that the neighbor lit the fire. The insurance company might pay the claim, but they might go after the person who lit the fire because it's that person's fault. Okay. Unilateral contract. This contract, so there's unilateral, aleatory, and contract of adhesion. Remember, contract of adhesion is on a take-it-or-leave-it basis. You must adhere fully or nothing at all. Aleatory is unequal exchange of value. Aleatory is unequal exchange. Okay? And then a unilateral contract refers to agreements in which only one party, the insurer, is obligated to pay the claim. Okay? So, in unilateral contract, the life insurance company is so a life insurance policy is a unilateral contract where only the insurance company is legally obligated to pay a death benefit to the beneficiary upon the insured's death, providing the premiums have been paid. So the policyholder is not legally required to pay their premiums, but if they stop, the insurance company is no longer bound to provide coverage. So life insurance is unilateral because a unilateral, only one, right? So you see one. So it's a one-sided contract where the only person legally bound to pay is the insurance company. Utmost good faith. So this has to do with the belief that both the policyholder and the insurer need to know all material facts and relevant information and are thus obligated to disclose this information to each other, ensuring that neither party withholds important details that could affect the agreement. So this is honesty from both sides. This is where both the insurer and the insured must tell the whole truth. Example, when applying for life insurance, the policyholder discloses all relevant medical history, such as pre-existing conditions or surgeries, to the insurer. In return, the insurer provides accurate details about the policy's terms, including any exclusions or limitations. Both parties rely on utmost good faith to ensure that the contract is based on complete and truthful information. So next we're going into valued contract. Remember, we had valued and indemnity. So this is valued contract, which is a type of insurance contract that pays a specified amount regardless of the actual loss. A life insurance policy pays the face value of the policy upon the death of the insured, regardless of any other financial factors. So life insurance is typically a valued contract because it pays a flat amount, no matter what. An indemnity contract only pays a specific amount to restore the insured to how they were before the loss. So like if someone crashes a car, they don't get a flat amount every time, right? The amount that they're reimbursed is just intended to restore them to where they were before the loss of the vehicle or whatever had to be fixed. Voidable contract is a contract that can be legally voided by one of the parties under certain conditions acceptable to the court. So this is something that can be canceled and can be ended by one party under certain conditions, like fraud. So a life insurance policy may be considered a voidable contract if the policyholder is found to have misrepresented their health status during the application. For instance, if they claim to be a non-smoker but they were a smoker, the insurance company may actually void the contract and deny the death benefit due to this material misrepresentation. Waiver, the voluntary relinquishment of a known right or legal claim. So this is when you give up a right. All right? So the insurance company would give up a right, like collecting premiums after a disability. So remember we talked about the waiver of premium? This is when the insurer will give up their right or legal claim to premiums if the insured is disabled. So a life insurance company may issue a waiver of premium rider, which allows the policyholder to stop making premium payments if they become disabled. By offering this rider, the insurer waives its right to collect future premiums while keeping the policy in force. And last, we have warranty. A warranty is a statement provided by the applicant guaranteed to be completely accurate. It's incorporated into the contract, and if proven false, it may result in the contract being voided. So this is guaranteed truth, and it's a statement that must be absolutely true for the contract to be valid. So in a business key person life insurance policy, the company might warrant that the insured key person does not engage in any hazardous activity like skydiving or mountain climbing. If this warranty is proven false, the insurer could void the policy because the specific activity significantly impacts the risk. Okay, so on to the next set of vocabulary words. If you find this information valuable, please reach out to me or click the link in the video for a copy of my study guide. And you can also email me at jve@thejbe.com if you'd be interested in learning about our agency and what we do. Okay, so adverse selection. This refers to the likelihood of individuals with higher risk profiles being more inclined to purchase or maintain insurance coverage, which can be detrimental to the insurance company. Effective underwriting practices help mitigate this issue. So adverse selection is the idea that really, it's based on the idea that the people who want insurance the most are the ones who are at the highest risk of having to file a claim, right? Like younger people with no health issues are not as likely to want life insurance or health insurance as people who are older or people who do have health issues, right? Because there's a higher chance of them using the claim, so they understand the risk. So adverse selection is with high-risk shoppers. So it's when high-risk individuals are more likely to get insurance. So the insurance charges more or screens carefully. Example, a 62-year-old smoker with a history of heart disease applies for life insurance. Knowing his health increases the chances of needing coverage, right? The insurer, recognizing this, charges a higher premium after reviewing his medical records to offset the potential cost. So that's why insurance companies want everybody to get insurance, whether you are healthy or not. You know, they want high risk and low risk individuals to balance out the high risk. And if you are high risk, then they're going to charge you more money. So I'm raising my desk here, so you may see me. Woohoo! Look at it. If you can see, I don't know, I might not put the video in this video, but anyways, age change. So age change So there's two ways to measure age in life insurance. One is the age nearest, and the other is age last. Okay, so we're going to talk about age change here. This is age nearest, the specific date midway between an individual's birthdays when their age is considered to move to the next higher age. Some companies calculate this based on nearest birthday, while others use the last birthday. So if it's age nearest, then what that means is like a 7-month-old baby is closer to being 1 year old than 0 years old, right? So once someone passes that halfway point, they're considered a year older in the insurance company that's using age nearest. But if they use age last, then that baby who's 7 months old would be considered 0 still. So example, an applicant turns 45 in June, and the insurance company uses the nearest birthday method. Since his next birthday is closer than his last, in December, his age for underwriting purposes changes to 46 in July, even though he's technically still 45. So it turns 45 in June. In July, since his next birthday is closer than his last, in December, his age for underwriting purposes, so in December, his age would turn to 46, right? Because he's more than halfway through being age 45. If he turned 45 in June, some point in December, he would turn to 46, even though he's still technically 45, right? So this usually results in a higher premium based on the new age. So the applicant is the individual who submits an insurance application. We went through this, but this is a little bit different spin. So this is the individual who applies for insurance. Okay, they fill out and submit an insurance application to the insurance company. Generally, the applicant is the person to be insured, though this is not always true. Excuse me, coming over cold here. Example, Sarah completes an application for a life insurance policy on behalf of her elderly father. Although she is the applicant, her father is the one being insured. Sarah provides all the necessary information and signs the documents to submit the application to the insurance company. If Sarah were to apply for her own life insurance, she would be the applicant and the insured. Next is application. Okay. The application is a document containing essential information provided by an individual when applying for life, health, or disability coverage. This information is crucial for the insurance company's underwriter to decide if the applicant meets the company's criteria for coverage. The applicant becomes part of the insurance contract. So when someone applies for a policy, they fill out an application detail. That's pretty straightforward. Attending physician statement, or APS. Okay, attending physician statement is a document requested when an application or medical examiner's report uncovers past or current conditions or circumstances requiring further clarification. So the applicant has to authorize the release of their medical information due to patient confidentiality, allowing the physician to share details with the insurance company's underwriter. So what can happen, the insured can apply, something can come up, and now they want the physician to give a statement on it so the insurance company can make sure that it's a risk that they're willing to accept, essentially. So example, John, during the process of his life insurance application, his medical exam reveals a history of high blood pressure. The insurer requests an attending physician statement from John's doctor to get more details about his treatment and current condition. John signs a release form allowing his physician to provide the necessary medical information to the insurance company's underwriter for further evaluation. Next, we have backdating. Backdating refers to the practice of assigning an effective date to a policy that's earlier than the actual application date. This technique is used to reduce the applicant's age on paper, thereby securing a lower premium. State regulations typically restrict backdating to a maximum of 6 months. Backdating is prohibited for variable contracts due to the inherent investment risks. So, backdating is when you change the policy start date to get a lower premium. So we'll talk about the example here, and then I can clarify it more if I need to. So if a 30-year-old applies for life insurance but wants to benefit from lower premiums applicable to a 29-year-old, they might request to backdate the policy to when they were still 29, as long as it's within 6 months of the application date. So essentially, if I turned 30 yesterday, and I was 29 the day before, on a life insurance application, I might want to backdate it from when I was 29 because the premiums will be lower for a 29-year-old than a 30-year-old. Okie dokie. Binding receipt or unconditional receipt. A binding receipt is when insurance starts right away when the application and first payment are received. So this is an unconditional receipt. This is the type of acknowledgement given by an insurance company when an application is completed and the initial premium is paid. So this receipt ensures that the insurance coverage becomes effective immediately on the date of the receipt and remains active for a specified period or until the insurer makes a decision on the application. Example: when a person submits an application for insurance and pays their first premium, they may receive a binding receipt ensuring their coverage starts right away and continues unless the insurer denies their application. It's a binding receipt. Buyer's guide. A buyer's guide is essentially a guide for shopping for insurance. Okay, it's a booklet that explains the different types of insurance to help you choose which one to get. Okay, a buyer's guide is a brochure that outlines and compares different types of life or health insurance. Producers are required to provide this guide to potential customers when soliciting insurance, enabling consumers to make well-informed decisions about their insurance purchases. Example: when an insurance agent meets with a potential client to discuss life insurance options, they provide a buyer's guide that explains the various policies, helping the client understand their choices before making a decision. So that's a buyer's guide. It's just like a little booklet that the insurance companies are required to give people so that they can do their own due diligence. Okay. Conditional receipt. A conditional receipt is a document that an agent signs and gives to the prospective policy owner at the time of completing a new insurance application. The terms for issuing this receipt vary by company, but it generally involves collecting an initial premium and offering limited coverage under specific conditions until the policy is formally issued. If there's no valid conditional receipt, coverage does not begin until the policy is issued, delivered, and accepted, and the initial premium is paid. So this is it's like temporary coverage starts only if certain conditions are met, like a medical exam or something like that. So we'll look at the example. Sarah applies for life insurance and pays the first premium. The agent provides her with a conditional receipt, which states that if Sarah passes the medical exam and meets the insurer's underwriting requirements, coverage will be retroactive to the date of the receipt. However, if Sarah does not meet the requirements, the policy will not be issued and the premium will be refunded. Okay, so this is saying if Sarah passes the medical exam and meets the insurer's requirements, coverage will be retroactive to the date of the receipt of the payment. Okay, consumer report or investigative consumer report. A consumer report, also known as an investigative consumer report, is an in-depth background check that may involve interviews with an applicant's colleagues, friends, and neighbors to assess their character, reputation, and lifestyle. Insurance companies can perform these reports to gather information about an applicant, provided it does not infringe on privacy. A credit report is a common example. Example here, David applies for a high-value life insurance policy, and the insurer requests a consumer report to assess his financial stability and lifestyle. This includes reviewing his credit report and public records to evaluate his risk profile. The information helps the insurer determine the appropriate premium and whether to approve the policy. So it's just checking out, what's this person's life look like? This is usually more common on much higher face amount policies. That's where a consumer report would probably come into play for life insurance. Okay, credit report. A credit report provides a summary of, so a consumer report, real quick, is essentially a background check on your lifestyle, finances, and habits to help assess risk. Credit report is a financial history check, which is a summary of your credit score, debts, and financial responsibility. So a credit report provides a summary of an insurance applicant's financial credit history, including their credit score, debt levels, repayment history, and perceived credit worthiness. So, like, what's their credit score, right? This report's prepared by an independent organization that reviews the applicant's financial standing. Credit reports are usually sourced from one of the three primary credit bureaus, Experian, Equifax, or TransUnion. When Sarah applies for life insurance, the insurer requests her credit report from Experian. This report provides a summary of her credit score, debt levels, and repayment history, helping the insurer evaluate her financial responsibility and assess the risk involved in offering her a policy. Okay, these words, by the way, have to do with underwriting. Okay. Declined risk. So declined risk refers to a person whose insurance application has been denied by the insurer. So example, an applicant has severe health issues that fall outside of the insurer's acceptable risk parameters. Their application may be categorized as declined risk and subsequently declined. So that's when they reject an application just because the person is too high risk. Disclosure form. A disclosure form is a standardized document mandated by various state regulatory bodies to be provided to every policyholder when an existing insurance policy is being replaced with a new one. So most states have a disclosure form that you need to give your client when you are replacing a policy. So most states have this. So if someone has a policy and they're canceling it or lowering the benefit to get another one or using the values to buy another policy, then they have to have a form. What this does, it essentially it helps them know what they're doing and understand that may not always be in their best interest. I mean, we'd hope that it would be always that the agent would be doing the right thing, but it's just so that the client's aware of what's going on. It isn't always in the best interest to replace a life insurance policy. If someone cancels one policy to get another one and the other one's more expensive and doesn't have any different features, then it might not be an ethical replacement, right? So example, John decides to replace his current life insurance policy with a new one that offers better benefits. His insurance agent provides him with a disclosure form, as required by state regulations, explaining the differences between two policies and any potential drawbacks of the replacement. This ensures that John is fully informed before making the switch. Okay. Evidence of insurability. Evidence of insurability. Hold on, I hit a button here. Okay. This is proof of health, when medical records or exams prove that you qualify for insurance. So that's the quick summary. But here, evidence of insurability is documentation or a statement regarding an individual's health history and current health status that verifies their qualification for insurance coverage. Example, Emily applies for a life insurance policy. The insurance company asks for evidence of insurability. Is it evident that you can be insured? Right? She provides her medical records and completes a medical exam to verify her current health status. This information helps the insurer determine whether she qualifies for the coverage and what her premium rates will be. Fair Credit Reporting Act. The Fair Credit Reporting Act, enacted in 1970, is a federal law that allows insurers to obtain additional information about individuals applying for insurance coverage. This legislation authorizes insurers to conduct consumer reports on applicants and prospective insureds. The insurance applicant must be notified of the purpose of the report. If the insurance is denied based on the report, the insurer must provide the name and address of the reporting agency so the applicant can request a copy of the report. Example, Michael applies for life insurance, and the insurer informs him that they will obtain a consumer report as allowed under the Fair Credit Reporting Act. The report will provide details about his credit history and financial responsibility. If Michael is denied coverage based on the findings in the report, the insurer is required to give him the name and contact information of the reporting agency so he can request a copy and review the findings. So this is a law for credit checks, and it allows your insurance companies to check your credit with your knowledge and give you access to the report. Field underwriter. So a field underwriter refers to the agent or producer responsible for completing the insurance application on behalf of the applicant. They call it a field underwriter because the insurance agent is essentially the front line of underwriting for the insurance company, right? You have to speak with the client or go to the client's house or meet with the client, and then you see right there, hey, is this person, right? It's a check as well on how the health questions are answered and how the questions on the application are answered. Because, someone can be like, no, I don't smoke, but their house smells like cigarettes, and they live by themselves, and there's ashtrays everywhere. It's like, okay, well, you probably smoke. I've had that happen before, so. Next, when someone applies for insurance, the field underwriter gathers all necessary information, fills out the application, and submits it to the insurance company for review. Free look period. The free look period is a mandated time frame, typically at least 10 days, during which a policyholder can review a life insurance policy after delivery and return it for a full refund if they are not satisfied. Example, after receiving the new life insurance policy, the policyholder has 10 days to review the terms, and if they choose to return the policy within this period, they'll receive a full refund of their premiums. So a free look period is essentially just it's essentially just a time that the person can get a refund on their policy if they don't want to keep it. So it's like, hey, you have this for however much time. You buy your policy, and then you have a certain amount of time to cancel for a refund. Okay. Gotta post this here. Okay. So, inspection report. An inspection report is a document that provides general information about an insurance applicant's reputation, health, lifestyle, and financial status compiled by a firm specializing in these investigations. So essentially, it's a detailed lifestyle review that includes details about your health, lifestyle, finances, stuff like that. When applying, like I was saying before, this is similar to consumer reports. When applying for a high-value policy, Lisa's insurer requests an inspection report to gather details about her lifestyle and financial stability. A third-party investigation firm interviews some of Lisa's acquaintances and reviews her public records to compile a report of her reputation, health, and overall financial status. This report helps the insurer assess her insurability and set appropriate terms for the policy. So insurable interest, we went over this before, but this is where you must benefit from someone staying alive to insure them. Okay? So insurable interest is the financial or emotional stake one party has in the life of another, justifying the purchase of a life insurance policy. I mean, we already went through this, but it's on this chapter too because it's important again. So essentially, insurable interest, financial stake, you have to benefit from someone staying alive in order to insure them. Medical Information Bureau, the MIB is also known as, is an organization that compiles medical data on applicants' life and health insurance on behalf of its member insurance companies. During John's life insurance application, the insurer checks his records with the Medical Information Bureau, MIB. The MIB provides data from previous insurance applications, revealing John's history of high blood pressure. This information helps the insurer verify the details John provided and assess the risk in offering him coverage. So, the MIB, it's a group of insurance companies. It's like insurance companies belong to the MIB, they're members, and they help each other. So they're like, hey, if John applied for insurance with one company a few years ago and he said that he had a certain health condition like high blood pressure, they want to let the other insurance companies know what's going on. That way he can't try to cheat the system, right? So, policy summary. A policy summary is a concise document. Oh, real quick, with the MIB, it's kind of like if someone has this used to happen to me before I got into insurance. So, a lot of banks, if you owe a bank money, say you're overdrafted a certain amount, you can't open an account at another bank. Just like sometimes when you start, if you start selling insurance, sometimes if you have chargebacks, which is essentially client cancels and you owe the company that paid you the money back. If your chargebacks reach a certain amount, then they will let other insurance companies know if you go to get insurance with them or get appointed to sell insurance with them, and they won't let them do it. So they'll be like, hey, this guy owes us money. Don't get with him because he just racks up debt. So that's kind of what, there's just companies watching each other's backs. Policy summary. It's a concise document outlining the key terms of an insurance policy, including coverage, restrictions, conditions, and premiums. These summaries are commonly provided for long-term care insurance, life insurance, and annuities to help consumers understand their policy's basic details. So when Maria receives her life insurance policy, it comes with a policy summary that outlines the key details. This includes her coverage amount, premium payments, and any exclusions and limitations, such as conditions that may not be covered. The policy summary helps Maria quickly understand the main points of her policy without reading the full contract. So a policy summary is essentially a snapshot of coverage. It's a short document summarizing key details of the policy, like premiums, coverage, riders, exclusions, stuff like that. Preferred risk. So this is when you're low risk and you get low premiums. The person whose life is covered, excuse me, this is applicants with great health, which is not me right now, I'm sick, and habits who get lower premiums. Preferred risk refers to an applicant who's considered to have lower than average risk of filing a claim due to their superior physical condition, lifestyle, occupation, and other favorable characteristics compared to others in the same age group. Okay. A non-smoker who exercises regularly and has no chronic illnesses might be classified as a preferred risk, resulting in lower insurance premiums. Proposed insured. The proposed insured is the individual whose life is being considered for insurance coverage. So this is the person whose life is covered by the insurance. While often the same as the applicant, it's not always the case. So I'll give you an example. Sometimes a parent can apply for a life insurance policy on the child. The child is the insured while the parent is the applicant. So the parent could own the policy and pay it, but the child can be the insured. You're going to learn there's an owner, the person who owns the policy and has the rights to it. There's the payer, the person who pays the premium, and then there's the insured, the person whose life is insured. Usually, the one person is all three, the owner, the payer, and the insured. But sometimes someone else can be one of the other parties, or a company even. Rated, well, you can't insure the life of a company, but a company could own it. Rated policy, rating up. So rated policy is essentially when it's a higher cost for higher risk. So it's a policy with higher premiums due to increased health or lifestyle risks. So rated policy involves an additional charge to the standard premium due to the insured being considered a higher than average risk. The higher risk assessment can be due to factors such as poor health or a hazardous occupation. Example, if an applicant has a history of heart disease, they may receive a rated policy, meaning they'll pay higher premiums to account for the increased risk. Okay? So if it's a rated policy, means that applicants at risk, they got to pay more. Replacement. Replacement involves a producer legally encouraging a prospective client to cancel or surrender an existing life or health insurance policy in order to buy a new one. So this is when you switch policies. It's canceling an old policy to buy a new one requires proper documentation. So this activity requires the producer to provide a notice regarding replacement to the consumer and inform the insurer about the replacement. Example here, when an agent recommends that a client switch their current life insurance policy to a new one with better terms, they must provide a notice of replacement and notify the new insurer of the change. Some states require you notify the old insurer of the change too. So we went over representations, statements you believe to be true. Okay. Most states' laws dictate that statements made by the applicant are regarded as representations rather than warranties. So in life insurance, they're mainly representations. So representation is required to be reasonably accurate according to the applicant's understanding. A representation is deemed fraudulent if it pertains to a significant factor in assessing risk and was made with intentional deceit. Example, when applying for life insurance, David states on his, we already went to that, risk classification. So this refers to the underwriting category that there's applicants assigned to based on their likelihood of dying or getting sick. So example here, but it's really like preferred, standard, and substandard, and then decline. So preferred risk, what the exams want you to know usually is there's a preferred risk, super healthy. Standard risk is average health, substandard is below average, and then decline is health to where we're not accepting the risk. After reviewing Mary's life insurance application and medical exam, the insurer places her in the preferred risk classification due to her excellent health and non-smoking status. This classification qualifies her for lower premiums because she's considered less likely to experience illness or death. So this is groups based on risk. Next is special class, special conditions with a higher risk. A special class refers to an applicant who doesn't qualify for a standard policy but may obtain coverage with an added rider that excludes payments for losses related to certain pre-existing health conditions. Okay. These applicants might have to pay more money, higher premiums, or accept a different type of policy than originally applied for. John applies for life insurance but is classified as a special class applicant due to his diabetes. Although he cannot qualify for a standard policy, the insurer offers him coverage with a rider that excludes any claims related to his diabetes and requires him to pay a higher premium to account for the increased risk. This allows John to get coverage, however, there are certain limitations. By the way, guys, on some of these pre-license courses, like I try on the one that this is material straight out of my pre-license course. So you're going to see that some of the stuff's wordy. It has to be that way to satisfy state requirements for the length of the exam. So that's why I try to give examples and summarize it and also provide some maybe little more simple explanations here too. Because some states, you have to have a course be a certain time length. So they want you to have it take 20 hours or 30 hours or whatever. It varies state to state. But that's why sometimes these courses are a little wordy, is because they have to make it that way, or else they won't satisfy the time requirement. So that's why I add videos and a bunch of other stuff too. But anyways, standard risk. So as I was going over, this is the average risk. So standard risk describes an individual who meets the average risk criteria according to an insurance company's underwriting standards, making them insurable at regular premium rates. Candidates classified as high risk or low risk may be eligible for higher or lower rates, depending on how much they differ from the standard risk category. Example, after undergoing the required medical exam and review of his lifestyle, Paul is classified as a standard risk by his life insurance company. This means he's considered an average risk based on the insurer's underwriting guidelines and qualifies for regular premium rates without any additional charges or discounts. So a standard risk is average health and lifestyle. Substandard or impaired risk. This applies to an applicant whose physical health falls below the typical minimum requirements for standard coverage. This can result from poor health or risky activities, leading to either a declined application or a policy with increased premiums. So an applicant in excellent health may still be considered substandard due to engaging in hazardous hobbies like scuba diving or skydiving. Diving in the sea or the sky. An applicant who frequently participates in extreme sports might be classified as a substandard risk and face higher premiums despite being in good health. So a substandard risk is essentially, or a higher risk, it's going to cost you more money. That's it. Underwriter. An underwriter is the risk assessor. We went over this before, but it's the person responsible for assessing, evaluating, and categorizing the level of risk associated with a potential insured to decide whether the coverage should be offered and at what premium rate. So this is the person who evaluates your application and determines your coverage and rates. Example, an underwriter reviews an applicant's medical records and lifestyle habits to decide if they qualify for life insurance and to set the appropriate premium. Underwriting. We went through this. This is where they figure out what you qualify for. They look at different sources. Here they look at your medical exam results, credit report, check your driving history. Depends on what you qualify for, but yeah. So this is warranties again. We're covering again. A lot of this material overlaps, so that's why some of these definitions are twice. In most states, laws indicate that statements made by the applicant on a life insurance application are treated as representations rather than warranties. So a warranty must be completely accurate and true in every detail. Unlike representations, a breach of warranty can void an insurance policy regardless of the materiality of the breach or its impact on the loss. Example, this is for a business insurance policy. A company warrants that a fire suppression system will be installed and operational at all times in their factory. This warranty is a critical condition of the policy. If a fire occurs and it's discovered that the system was not installed or functional, the insurer can void the policy even if the malfunction didn't directly cause the fire. The breach of warranty allows the insurer to deny the claim based on the company's failure to fulfill the exact terms of the policy. So warranty is a guaranteed truth. Most of the time in life insurance, it's going to be a representation. But a warranty is a statement of policy that must be completely true for the contract to be valid. Like I said, my belief for a warranty for a life insurance policy would be that the person applying who claims, the person, saying who I am, that's guaranteed to be true. Because if it's not, then it voids the policy. All right, so here we are going to cover the types of life insurance policies and then get into some policy riders and all that good stuff. So as I'm going through this, what I'm going to be doing also is I'm going to be using a whiteboard to help give you some illustrations and explain the different types of life insurance a little better. That might help you out rather than just words. And I'll do that with whatever I need to moving forward. If you find this information valuable, please check out the description in the video for a free study guide, and also in the pinned comments for a free study guide and any other products that we might offer and opportunities that I have available. And if you'd be interested in potentially working with me, just shoot me an email at jve@thejve.com so you can apply to be an insurance agent with me. So this is from an actual pre-licensed course that I built out. So I'm going to be going through these definitions and, like I said, illustrating them. So industrial life insurance. It's not that popular anymore. You're probably not going to actually have to sell this. It might not even be on your exam, but this type of life insurance provides small face amounts, typically $1,000 or $2,000. Premiums are collected by debit agents and are due on a weekly basis. Industrial life policies were primarily designed to cover final expenses. Example, a worker purchases an industrial life insurance policy with a face amount of $2,000 to ensure that their funeral expenses are covered. The policyholder pays a small weekly premium, which is collected by a debit agent who visits their home. So, life insurance agents used to also be debit agents. What this means is that they used to go home to home and collect the premiums from the insurance. They had a debit ledger or debit log or something like that. And they used to go and collect the premiums from the insured in the form of a check or cash. People didn't always pay bills with ACH. A lot of people used to have to mail in checks. There was no electronic payment. So people used to pay their bill for industrial life insurance weekly or monthly. This isn't common anymore. $1,000 to $2,000 of life insurance is so small. But this is a type of life insurance, and it may be on your insurance exam. It's also kind of cool to understand the history of life insurance as well. So now there's a different type of insurance for industrial life insurance. It's called final expense life insurance, and it's a type of whole life policy. Typically, they're non-participating whole life policies that are simplified issue, meaning there's no medical underwriting, so it's just a series of health questions people answer. It's kind of like you may hear the Colonial Penn, right? Stuff like that. But that's sold by regular insurance agents. It's a big industry right now. So that's basically industrial life insurance. What it was, it's not popular anymore. You might not even see it on your exam, but it's still something that's good to know in case you do. Ordinary life insurance. So ordinary life insurance is offered by commercial insurers, so private insurance companies, and is not based on weekly premiums. It includes various forms of individual life insurance, such as term life and whole life. We're going to learn about term and whole life moving through this here. So, ordinary example here, simple 35-year-old individual purchases an ordinary whole life or ordinary life insurance policy from a commercial insurance company. Commercial insurance companies are private companies, okay? So, private companies are commercial insurance companies, meaning they're not owned by the government. They choose a whole life insurance option, which provides permanent coverage with fixed premiums and a savings component. Unlike industrial life insurance, they pay premiums monthly rather than weekly, and the policy remains in effect their entire life as long as premiums are paid. Sometimes people will pay whole life or term life insurance policies annually. Sometimes it's a lump sum payment. The most common form of payment, though, is monthly payments because mostly people pay their bills month to month. Okay, next type. We're going to get into term and whole life and all the other types in more detail. Group life insurance. There's a whole chapter on group life insurance. There's a whole document in
definition section on group life. We'll get there in a little bit. Group life insurance covers members of a defined group, such as employees of a company, members of an association, or union workers. The coverage is provided under a single master contract with underwriting based on the group as a whole, rather than on individual members. A key benefit of group life insurance is that it typically does not require proof of insurability. So group life insurance, we'll get into this in more detail, but group life insurance basically is formed for the whole group of people. So our whole group of people. So like if they work somewhere or something like that, the whole group is covered. The group cannot be formed just for the purpose of getting insurance, though, right? Because that would be adverse selection. You'd have all the sick people who want it. So in group life insurance, it's with employers and things like that. And the whole group typically is guaranteed insurability, meaning everybody in the group not only should participate or can, but has to for some of the group life policies. Example, a large corporation offers group life insurance to its employees as part of their benefits package. Each employee is automatically covered under the company's master policy without needing to provide any medical information or proof of insurability. The insurance covers all eligible employees equally, and the company is responsible for the premiums. This allows employees to receive life insurance coverage without going through individual underwriting. So what I'm going to do here, I'm just going to bring this over here, and I'm going to just give you an example. So say we have the group master policy. Let's make this line a little fatter here. If we can color. Well, I don't know why it's can't. Let's see. Here we go. Weight. Okay. So here we have the group life policy. Okay. We're going to put GL, group life policy. And this covers everybody in the all the employees. So we have employee 1, and then another employee. Yay, I love working here. Yahoo, I get free insurance. Now we have Billy Bob Insured. That's his name here. This is Billy Bob Insured. He looks like an ant, but Billy Bob Insured is chilling. Except, the only thing is, he comes to work and he's like, yo, I want some insurance too. And the employer says, well, this is a plan that everybody gets, so you got no choice, bro. So the employer grabs Billy by the neck and whips him into the life insurance policy. Now all of a sudden Billy's here and he's happy. Yay, I have life insurance because I'm with the company. The thing is though, Billy does not own this life insurance policy. The owner of the policy is the company. Okay, so the company is the owner of this policy. Look at my drawing skills with my mouse. I'm pretty impressed if I could spell that. I wish I had an Apple Pen and an iPad, but I'm not that fancy. So the company owns this, and this is called the master policy, MP, master policy. So this is the master policy for group life insurance. While Billy works for the company, Billy Bob Insured is now under the policy. Billy Bob Insured one day decides, you know what, I'm sick of this company, I'm out. So now Billy Bob Insured is no longer part of the group life policy. One thing Billy Bob Insured can do, though, is he can leave and keep his coverage. So every state has a different law in place about, and different regulations in place about converting your group life to a whole life. A lot of states, it's 30 days. So a lot of states, they have 30 days to convert their group life insurance into a permanent whole life policy. However, most people usually don't do it. So we have conversion, right? We're going to learn about insurance conversion here. So a lot of times they don't convert it because it's so expensive. The only time it really makes sense to convert usually is if someone's very unhealthy. So that's basically how group life insurance works here. So we're going to put group life here. GL. Well, it's already right there, but whatever. So that's basically how group life works. One type of group life. I forget the exact name of it. I'm like super sick. It'll be later on in this video, and I'll refer to that illustration again. Okay. So bringing this back over here, and we're back here. So next we have term life insurance. We actually have 2 sections for term life insurance definition. That's how important it is. I didn't mean to do that twice, but it's okay. So term life insurance, provide the maximum coverage for a specific period of time. The term. The policy ends at a predetermined date, the termination date, and no benefits are paid if the insured survives the term. Term insurance is a cost-effective option, which makes it appealing for larger policies. larger face amounts, right? Term insurance is typically the most affordable type of pure life insurance due to its temporary nature and lack of cash value. It is consistently more affordable than a whole life policy with an equivalent face value. So typically, for a person of the same age and same health rating, a term insurance is going to be significantly cheaper for the same amount of insurance. A term policy is going to be cheaper for the same amount of insurance than a whole life policy because the term is only effective for a specific period of time. There's no cash value, any of that stuff. So term is temporary. There's a very, very low chance that the insurance company is going to have to pay out the claim. If someone gets approved for a term life policy, there's like a 98% chance they're going to outlive the policy or something like that, or more than that, probably. Those companies are very, very good at predicting if the person's going to outlive the term. A whole life policy, there's a 100% guaranteed chance the company's going to have to pay the claim at some point, right? They either, because they have it for their whole life or until age 100, which we'll get into in a minute here, but the person's either going to die or they're going to reach age 100. So at some point, the company's going to have to pay a claim. So that's why part of the reason why a whole life policy is more expensive than a term. Term offers pure death protection, meaning the death benefit is only paid if the insured dies during the policy period. And I'm going to get into an illustration here in a second. But a 40-year-old individual purchases a 20-year term life insurance policy with a face value of $50,000. The policy provides the greatest amount of coverage at a low cost because it has no cash value and only pays out if the policyholder passes away during the 20-year term. Since the policy is designed purely for death protection and will terminate after 20 years, it's significantly cheaper than a comparable whole life policy with the same face value. Term life provides the maximum amount of coverage for a specified time, making it suitable for temporary protection. It's valid only a specific time frame due to its termination date. It's more affordable compared to other life insurance policies, making it attractive for larger policies. It's the most affordable option to term life insurance. Yeah, okay, cool. Another example here. Another type of term is level term. So this is level premium term. Features a level face amount and level premiums through the policy period. Premiums are typically higher than those for annual renewable term insurance because they remain fixed for the entire term. Premiums will increase upon renewal. This is all going to make sense in a second here. So it's designed to cover specific needs set for a set period of time at the lowest possible premium. Like all term insurance, level term policies expire at the end of the policy period. Level term offers a consistent low premium in return for coverage over a predetermined time period. So let me break out my thing here. This will help you understand term a little better. So we're going to have the grid for term. So we're going to have, oh, hold on. That was sloppy. I hit my notepad. So we got, this is the grid for term. We're going to have money over, no, money over time. So if the red represents the premium, so we got the premium is the level. Now, I know that's not perfectly straight, but just imagine it is, right? The premium's the same, and they say it's a 20-year level term. At year 20, the term is no longer in force. And then we got the death benefit was here, this much, and then at year 20, the death benefit is no longer in force. So term is term, and it terminates. So this is a termination date, and there is no cash value in a term, which means there's also no dividends. So no cash value on a term, okay? Now, this is a 20-year level term right here, where the premium is the same. It's a level premium. So when you see level term, it just means level. The premiums are always level on a term policy. Okay, the premiums never change. There is a annual renewable term, which would be something like this, where say the premium starts here for a year, and then the premium is a certain amount for a year, and then it increases, and then the next year it's a little more, and then the next year it's a little more, and the next year a little more, yada, yada, yada. Okay? That's how the premium would increase for an annual renewable term. That stands for ART. Okay, now this isn't exactly the best example to show the premium relationship between a level term and an annual renewable term, because it would most likely be something like this for the level and annual renewable term comparison, right? It'd be like they're gonna pay more up front on a level premium term to pay more later. To pay less later, like less than the cost, right? Because an annual renewable term is a 1-year term policy. So they have life insurance just for 1 year. So we'll show you that here. Annual renewable term insurance provides coverage with a level face amount that renews on an annual basis. So the policy renews every year. So what happens is, at first, the policy is cheaper for a year, and then at 1 year later it goes up a little more, and then another year later it goes up a little more, and another year later it goes up a little bit more. Whereas the level term, someone says, yeah, I just level, give me an average of the premiums, give me a level premium. The premiums averaged out over the entire 20-year term. So whereas the annual renewable starts cheaper, and then it just goes up a little bit every year, okay? And then decreasing term refers to the death benefit. Okay, so on a decreasing term policy, it would be the death benefit would decrease. So a decreasing term policy, the death benefit would decrease over time. It's usually to cover something like a mortgage, right? Because a mortgage is going to decrease over time, the amount that's owed on the house. So the premium for the decreasing term is probably going to be lower than the premium for the level term, right? Because the death benefit is level. It's the same for a level term policy. The death benefit's decreasing for a decreasing term policy. Okay. So when we're talking about level term and decreasing term, we're not the level and decreasing term words. They're not talking about the premiums. The premiums are always level. They're always going to be the same level or the same amount on a term policy. What's decreasing or remaining level in those policies is separately is the face amount, the death benefit, okay? Okay, decreasing term, we're going to that next. So offers a face amount that decreases over time while premiums remain constant. Primarily used for mortgage or debt protection, where the outstanding balance decreases over time until they're fully paid. A decreasing term policy is a type of life insurance where the death benefit gradually reduces over time based on a set schedule and is designed for a specific term. Example, Mark takes out a 15-year decreasing term life insurance policy to protect his 15-year mortgage. Okay, 15-year term life, he has a 15-year mortgage. Each year, as Mark pays down his mortgage, the face amount of the policy decreases to match the remaining balance. The premiums, however, remain level throughout the policy's term. If Mark passes away during the policy period, the death benefit will cover the outstanding mortgage balance. Once the mortgage is fully paid off, the policy expires. Okay? We're going to look up here. I didn't go over this example. So Sarah, this is a level term. Sarah, 40-year-old, wants life insurance coverage for the next 20 years until she retires. She chooses a 20-year level term life insurance policy with a face value of $250,000. The policy has a fixed premium that remains the same throughout the 20-year period. This allows Sarah to pay consistent, affordable premium while ensuring that her beneficiaries are protected if she passes away during her working years. If Sarah outlives the policy, it will expire at the end of 20 years and no death benefit will be paid. So a 20-year level term just has a consistent death benefit throughout the entire term. Credit life insurance. This is a decreasing term life insurance policy where the policy term matches the loan period, and the face value decreases alongside the loan balance. The purpose is to cover the life of a debtor. A debtor is someone who has a loan, who has a debt, right? Ensuring that the loan is paid off if the debtor passes away before fully repaying it. It's only possible to purchase a credit policy in an amount that equals or is less than the outstanding debt or loan. So if you're getting a credit life insurance policy, it can't have a higher death benefit or face value than the loan itself. Here, David takes out a $30,000 7-year auto loan and purchases a 7-year decreasing term life insurance policy with an initial face value of $30,000. Throughout the term, his premiums remain level, but the face value of the policy decreases each year in line with his declining loan balance. If David were to pass away before the loan is fully repaid, the insurance policy would cover the remaining loan balance. Once the loan is paid off, at the end of the 7 years, the insurance policy will expire as it was designed specifically to cover the auto loan. Okay. Hey, I hope this is helping you guys. I know this exam can be pretty stressful, and I know it can feel like you got the weight of the world on your shoulders, but I promise you, you can do this 100%. I know that you can pass your exam. I know that you can make it happen. And this is an extremely rewarding, lucrative career. So just stick with it, push through all the frustration and like anxiety that you may be feeling, and just stay focused. And I promise you, you can pass this exam, you can get your license, and you can start a lucrative career in the insurance industry. Next, we're going to go to increasing term insurance. So increasing term insurance, it's like, this is very unpopular. It's probably not even going to be on your exam, but provides a death benefit that increases over time. Okay. It's not even really worth covering it right here, but it's the opposite of decreasing, right? So if we have a decreasing where the death benefit decreases over time, on an increasing, the death benefit will increase over time. Okay. All right. Convertible term insurance. So convertible term has to do with it's a feature of a term policy. It's not like decreasing in annual, renewable, and level. It's not like a type. It's more of like a feature. It's an option on a term policy, more like it. So convertible term insurance policy, includes a provision that permits policyholders to change their term insurance into permanent coverage, which is whole life, without needing to provide proof of insurability. Term insurance allows for temporary coverage that can later be switched to permanent insurance without needing to provide proof of insurance. So you have temporary policy that can be turned permanent. So it's ideal for individuals who initially want lower premiums but later seek permanent coverage as their financial situation improves. So someone will get a term policy, and it's because it's cheaper upfront than whole life, right? Term policy will in general be cheaper upfront than whole life for the same face amount. And then over time, they can convert it. So I'll give you an example of where that might happen. Say, some dad, he really, really wants to be there for his family and provide coverage to them so that if he dies, his income can be replaced. So say he's the breadwinner, and he's like, okay, well, if I die, I want my family to have a certain amount of money, at least for the next 20 years. So he gets a 30-year term policy. After 20 years of having that policy, say maybe all his kids have moved out and they have jobs of their own and they're leading successful lives. And he's like, well, maybe I don't need as much insurance as I have on the term anymore. And I'm looking to convert into something that would be a little bit more permanent, like a whole life policy, to leave an estate to my family, leave a guaranteed estate. Because he's like, say 20 years pass by, he's still pretty healthy. Chances are he's going to outlive the term policy and he'll lose coverage. And he doesn't want that to happen. So he wants to convert it to a whole life policy, or a portion of it. So he can take a piece of it or the whole thing, convert it to a whole life policy. If he converts the whole thing, it's going to be significantly more expensive. Say it's a $100,000 policy. That's a term life. It's going to be way more expensive for a $100,000 whole life, but he can convert the whole amount or a portion. So say he's like, well, I want to convert, $30,000 into whole life, or whatever the case is. He could do that. He could convert it. So, for instance, if you purchase a term insurance policy while you're young to benefit from lower premiums and good health, but wish to convert it to a permanent coverage later for final expense benefits when your financial situation improves, a convertible term life policy would be ideal. A group term life policy conversion privilege enables an individual to transition, we just talked about this, to transition from the group term temporary coverage to an individual permanent plan. It says plan, should be planned, without needing to provide insurability. When deciding whether to convert term insurance based on the insured's attained age or original age, the most crucial factor is to consider its premium cost. The primary element affecting life insurance premiums is the insured's current or attained age. For example, a $30,000 policy for a healthy 10-year-old will be significantly cheaper than a same policy for a 6-year-old, right? When converting a term policy, whether individual or group, your insurability is guaranteed, but the premium will be calculated based on your current age rather than the age when you first obtained the policy. Convertible term insurance allows you to switch to permanent coverage without needing to prove insurability, but expect to pay higher premiums. Example, Jake buys a convertible term life insurance policy with 20 years coverage. At 45, he decides to convert it to a whole life policy for a permanent coverage. He doesn't need to provide proof of insurability, but his premiums increase based on his attained age of 45 at the time of conversion. So when you do convert, your premiums are based on that age. So let's see if we can illustrate this here. I don't even know, without redrawing everything. I mean, so this is what we're going to do. We're going to erase some of this stuff. We're just going to say they got a level term. We're going to get rid of this annual renewable term stuff here. Okay. And so say, we're going to get rid of this too. Okay. So say they got a 20-year level term, okay? And the premium is right here, okay? Now what happens is they can convert a portion or, the whole thing, but say they want to convert a portion of this at year 15. Essentially here, what they can do is convert that into a whole life policy. Now, if the premium was, say, this much or that much for the term policy, the same premium might be like that much, without putting any values on it, that much for the whole life. So the premium will increase significantly for the whole life policy. Okay, so here when it converts, well, it's a bad example. Say they convert it here, right? So it'll be right here where they convert, and then it's going to be whole life, and it'll start increasing in cash value too, and then that part wouldn't exist on the term. So it would just go up to here. If they wanted to keep the, that could be done, but maybe they would just want to lower the face amount of the policy. So if they kept the premium the same, they would not convert as much. They'd convert a smaller piece. All right. Okay. My computer was just making some noises. Let me check on something here. Okay, cool. Renewable term insurance guarantees the right to renew the policy after the initial term expires without requiring proof of insurability. All term insurance policies have a final termination date after which renewal is no longer possible. So this guarantees your ability to renew the policy after the initial term expires. So essentially, this one here where we're looking at the 20-year term, okay, say we're looking at a 20-year term. Okay, so say we're just looking at a 20-year term, where when it terminates there, in a renewable term, you could actually renew this policy and extend it for more time. You could extend it for more time. The premium will go up, though. The new premium would be based on the new age, the attained age. So the new premium will be based on the age the client's at when the policy renews. Sarah buys a 15-year term life insurance policy, renewable term life insurance policy, After the initial 15-year period ends, she chooses to renew the policy without providing proof of insurability. Although her premiums increase with each renewal due to her age, she can continue renewing the policy until she reaches the maximum age allowed by the insurer, at which point the policy will no longer be renewable. Annual renewable term provides coverage with a level face amount that renews on an annual basis. So we covered that before, right? Where it's a level face amount, so the face amount never changes, but every year the premium increases as the policy renews because it renews every year. Okay? Policy is guaranteed renewable each year without providing evidence of insurability, meaning you don't have to apply for it again or submit anything to underwriting to be approved for it. So example, Tom purchases an annual renewable term life insurance policy with a face value of $100,000. Each year, the policy automatically renews without requiring Tom to prove insurability. Tom can continue renewing the policy each year until he gets too old, as long as he pays the premiums. So say in year 1, it's $30 a month. Year 2, it's $32 a month. Year 3, it's $35 a month. Year 4, it's $39 a month. So it's just going to keep increasing like that over time. Whereas, say it's a 20-year level term, it'll be like, $52 a month for the whole term, something like that. Okay, term rider. So we'll be getting into riders in the next section, but a type of life insurance that extends coverage to children under the policy of the parent. So there are a couple different types of term riders. Essentially, a term rider is when someone gets a life insurance policy and they add additional coverage for either themselves or someone else with a rider. So if it's a whole life policy, they're going to add a term life rider for themselves, and they can add it for someone else too. Some term policies offer term life riders as well for other members of the family. So a type of life insurance that extends coverage to children under the policy of a parent. So there's different applications for a term rider. Family plan policies often provide permanent coverage for the family head. Permanent coverage is a whole life, while the spouse and children are covered through term riders. So it's like saying, okay, so say the dad gets a whole life policy, and then he can add his wife and children on as term riders. Okay. Term riders are always structured as level term policies. This option is more affordable than having separate policies for each family member. For instance, the main policy may cover the father, while the spouse and children are attached as term riders. This allows for the entire family to be covered under a single policy by attaching additional members to a primary policy. Term riders also allow applicants to add extra coverage for themselves by attaching additional riders to the main policy. So I'm going to show you on an illustration here, and I'll use my whiteboard. Okay, so a lot of term riders will actually expire. Okay, so a lot of these term riders are going to expire, but I'll show you an example. Actually, they all do eventually. So we're going to draw a little line here, and we're going to do our new blank canvas. So say we got, there's the main whole life policy, okay? So we have dad's, that example I gave, dad's whole life policy, okay? So dad is covered. He has his whole life policy. Say it's $100,000, okay? Example. Now, this is permanent, so P, permanent insurance, okay? So this could be permanent for dad. Now, what we have here is he says, well, I have my whole life policy, but I want to cover my wife and then our two children under this. I want them to have life insurance coverage as well. So it's kind of like bundling, but not really. And I guess you could look at it that way. It's just stacking policies on top of each other. So essentially, and it just helps with underwriting, and typically a term rider for someone would be cheaper than them getting a separate term policy on themselves. So that's what's the advantage. But say now we got mom. Mom's got some wacky hair going on. She's happy because she's got her insurance. And then she's got a baby in her arms too. So that's a little baby carrying in her arm right there. Okay, and then, so say they got 3 kids, and then here's little Billy. Billy's got a wacky hairdo, and then this is Susie. Susie's very happy because she has it. If my daddy dies, I'm getting a bunch of money. Oh my gosh. So that's Susie, which would be very, very unfortunate. So we have Susie there, and then we have her mom, and then her brother, and then her other sibling. I don't know if it's a boy or girl. Can't tell from the drawing. So dad has a whole life policy, and then there's a $50,000 term life on this child, $50,000 term life on this child. Say, for example, different term riders have different features, but say that covers them until they're 25 years old. They're each going to have $50,000 in term life until they're 25 years old. And then mom has a $100,000 rider, say 100K, for, I don't know, say it's 20 years or something like that, however long it lasts. So that's additional coverage on them. That's all included in this it's attached to this policy. So it's like one single premium that comes out, right? It's not like these all have their own separate costs, but it's not like on his bill every month. It's like, it's not like he gets charged 4 or 5 times. It's just, yeah. And then, we forgot 50K on this little one too, 50K. Dad can also get an additional $300,000 or whatever. Say he gets an additional $300,000 term for 20 years because he says, okay, well, my kids are young. I'm going to want $400,000 in total coverage for the next 20 years, but I do want to have some permanent coverage, and I want to start building cash value now, right? He wants to start building cash value now, and he wants to have additional coverage, but he doesn't want to pay the premium for a $400,000 whole life policy. So this gives, plus he also wants to have his family covered. So this gives him an opportunity to get a $100,000 whole life policy for him, start growing some cash value, and lock this in when it's a cheaper premium because he's younger. And for the next 20 years, he'll have an extra $300,000 term policy. Because if he got a $400,000 term policy and then waited 20 years to convert this to a $100,000 whole life, the premium for the whole life would be way higher because it would be based on his age at the time of conversion. So this is how he can save some money on a whole life policy now, get more coverage for his money by adding a term rider, and make sure that his family has everything in the policy as well with a term rider. So I hope this helps you understand kind of how that functions there. Okay, and you guys can go back and pause that if you need to. Yeah, okay. Whole life policy. Next, whole life. Term. So to remember the features of the term, something that you can look at is cradle. So CRADL, cradle term, can be convertible or renewable or annual, decreasing or level. Okay? Cradle. So whole life policy, whole life insurance. Death benefits are provided. Well, here, I'll let you guys take notes on that for a second. Hold on. If you need to pause it, you can too. Okay. Whole life insurance. Death benefits are provided for the whole life of the insured. It offers living benefits through accumulation of cash values. These policies typically mature when the policyholder reaches the age of 100 and usually have level premiums throughout the policy duration. All whole life policies offer the same core benefits: permanent coverage until death or age 100, level premiums, and level death benefits with the accumulation of cash value. So it has permanent, it has coverage that lasts until age 100, the premiums remain level, and the death benefit is level as well. The main difference between the types of whole life policies lies in how premiums are paid, and some cash value is invested in different ways. There's variable whole life, which we'll get into in a second. But some policies are paid all the way until death or age 100. Some have a shorter premium payment, which is a set number of years or until a specific age. And then certain policies may offer lower premiums in the beginning years to make them more affordable, and then the premium increase later on. And then also some will allow them to pay for a policy with a single premium payment. Whole life insurance is often compared to buying a house. Once it's fully paid, you still own it for life, with long-term value building over time. Example, Mary buys a whole life insurance policy with fixed premiums until age 100. The policy provides a death benefit for her entire life and builds cash value over time. Regardless of the payment method, the coverage lasts until death with level premiums and cash value, much like buying a house that builds equity. Types of whole life insurance. Straight life insurance, straight whole life. So I'm going to illustrate these for you. I'm going to read it first and then illustrate it. So for straight life, premiums are paid for the duration of the insured's entire lifetime, with coverage continuing until death. In other words, premiums are payable for as long as the coverage remains in effect. Similar to other whole life policies, straight whole life offers level premiums, a consistent death benefit, and cash value accumulation. Whole life insurance also mandates that the insured be paid the face amount upon reaching age 100, which is when the policy reaches maturity or when it endows, if a death benefit has not already been dispersed. If someone seeks a policy with a fixed premium and a benefit that is paid out either at death or upon reaching age 100, they should consider a whole life policy. So obviously the policy would be paid upon death, but this means like a policy with fixed premium and a benefit that's paid out at death or upon reaching age 100 that can't expire. So that'll never expire or never terminate. Straight whole life insurance coverage provides coverage for your whole lifetime and allows you to distribute the cost evenly across your life. Sarah purchases a straight whole life insurance policy with fixed premiums that are payable throughout her lifetime. The policy guarantees a level death benefit and accumulates cash value over time. If Sarah lives to age 100, the policy will pay out the face amount. Or if she passes away before then, the death benefit will be paid to her beneficiaries. I'm going to go through all these types and then I will illustrate it. Whole life limited pay. So this is where coverage remains in force until age 100 or the insured's death, whichever comes first, while the premium payments are limited to a specific period. So they only pay premiums for a certain amount of time. right? So while premiums are only paid for a designated time, the insurance protection extends for the entire lifetime or until age 100. So even though they're only paying for a certain amount of time, they have it for their whole lifetime. So like term insurance, they pay for a specific amount of time. The insurance only lasts for a certain amount of time. Limited pay whole life insurance, they pay for a specific period of time, but the coverage lasts their entire lifetime or until age 100. So this is ideal. Or for instance, if you purchase a 10 pay policy, premiums are paid for 10 years in a row, after which no further payments are required. Coverage is then guaranteed until death or age 100. If any of this is confusing you guys, I'm going to go through it in the illustration here in a minute, but I promise you, go through this a few times and study, and you'll get it down. This is ideal for those wanting to retire without ongoing premium payments, such as a 35-year-old who wants the policy with level premiums, permanent protection, and no premium payments after retirement at age 70. The applicant would select a paid up at age 70 limited pay policy. A limited pay life policy offers lifetime coverage with level premiums that are fully paid over a shorter defined period. Example, Taylor buys a 10 pay whole life insurance policy. He makes premium payments for just 10 years. After this period, no additional premiums are required, but the insurance protection continues until Taylor's death or age 100, whichever comes first. Okay. So I'm going to actually start illustrating these right now for you guys so you can better understand them. So we have ordinary whole life, or not ordinary whole life, straight whole life, which is ordinary whole life, I guess, traditional whole life. We have, once again, money over time. Okay. So we're going to have the premium in red. So say they pay the same amount over time. Okay. This is age 100. And then we have cash value, which usually starts in year 2. So say cash value, these amounts are not relative, okay? So this is not saying that the whole life is going to be more than the premium. The premium is actually going to be a lot less, a lot more than the cash value. Sorry. Do not take these as relative here, okay? The graph's too small to show that, but I'm just giving an example. The premiums are level, the cash value increases over time, and then the death benefit's always going to be level too. So the orange is the death benefit. That's always going to be level. Okay. So that's with a traditional whole life. All right. If you have a limited pay whole life, the premiums will be more starting out, but then they'll end at a certain age. And then the policy still continues on after that. So the life of the policy will still be in force after. So with a limited pay, it costs a little bit more each year, but overall the lifetime of the policy, they usually end up paying less and it stops earlier. Okay? Next, cover that. Modified. So a whole life policy where the premium remains the same for the first 5 years, then increases in the 6th year and stays level for the rest of the policy period. Offers the same features as standard whole life insurance, including fixed premiums, cash value accumulation, and a level death benefit. That's after the first 5 years, right? For the premiums. The key difference is that the insurance company doesn't charge as much for the premiums in the initial 5 years, making it more affordable initially. So this is ideal for people who want the benefits of whole life but need an affordable option during the early years. So example, Emily, a college student, purchases a modified whole life insurance policy. For the first 5 years, her premiums are lower to fit her budget. After this period, the premiums increase and stay level for the remainder of the policy. This option allows Emily to benefit from whole life insurance while paying reduced premiums during her college years. So we're going to look here for the modified. We're going to say it's a little lower at first, and then after 5 years, it increases and it's going to be more. Okay, so that's like the modified. If you look at that there, okay, that makes sense. Okay. Whole life modified endowment contract. So there were issues where people were essentially, I guess, trying to evade taxes with their whole life policies because there are tax benefits to your cash value accumulation. And the IRS passed a limit on how much can be put into the policy. So a modified endowment contract is a whole life policy that exceeds the IRS limits on the amount of premium that can be paid into the policy while still being considered a life insurance contract. if it fails to meet the 7-pay test, which ensures that the policy is not overfunded. When a policy fails this test, it's classified as a modified endowment contract and loses its favorable tax treatment. The 7-pay test discourages schedules for premium payments that would allow a policy to be paid up in less than 7 years. Once classified as a modified endowment contract, you have surpassed the maximum allowable premium for the policy to still qualify as a life insurance contract. So you can't, it's like overfunding a whole life policy. So Jamie buys a whole life insurance policy that pays $15,000 and pays $15,000 in premiums over the first 5 years with an annual premium of $2,000. Since Jamie has paid a total that exceeds the $14,000 limit, 7 years and $2,000, the policy fails a 7-pay test and is classified as a modified endowment contract. So essentially, he gets a whole life policy, and his premium is $15,000 over the first 5 years. So he's like, I'm going to pay $15,000 into this policy in 5 years. But the annual premium of the policy is only $2,000, right, for that face amount. So if Jamie pays in more than the allowable limit, right, 7 times 2,000, then in that 7 years, then the policy fails a 7-pay test. So this loses favorable tax treatment for the policy. So it's just to make sure that people can't pay too much for their insurance policies. Okay? Okay. All right. Next, joint life policy. A joint life policy. Here, and then we're looking at this one here. There's also a single premium whole life. So that's just one premium paid at the beginning, and then they never have to pay again. It'll be in the vocab that I'm going over, but that's for a single premium whole life. They pay once, and then that's it. Joint life policy insures two individuals and reduces premium cost by averaging their ages. So two people have a policy together. The policy pays out the face amount on the death of the first insured. Okay? The first insured. Similar to a joint checking account where the account is shared between two people and the surviving person receives the full amount after the other passes away. A policy that pays the face amount upon the death of the first of the two insured people is known as a joint life policy. Example, Alex and Taylor purchased a joint life insurance policy. The policy covers both individuals and offers a lower premium by averaging their ages. If Alex passes away, Taylor receives the full death benefit and the policy terminates, with Taylor no longer being insured under that policy. This type of policy pays out the full face amount upon the death of the first insured person. Okay, next we have a joint survivor or last survivor life policies. Covers two individuals and reduces premium costs by averaging their ages, so same as up above. Unlike a joint life policy, a joint survivor or last survivor policy or survivorship policy only pays out the death benefit after the second insured person dies. These policies are designed to cover two people's lives, but only pay the death benefit upon the death of the last insured individual. So, I mean, you'd think it would be the opposite based on the wording, but I just want you to remember that in a survivor policy, the coverage is still in force on the survivor. Okay? So in a survivor policy, the coverage is still in force on the survivor. So that's the way to remember it. Okay? Example, Jordan and Casey purchase a joint survivor life insurance policy. The policy covers both individuals and offers lower premiums by averaging their ages. If Jordan dies first, the policy provides no benefits until Casey also passes away. Only after the death of the last surviving insured, Casey in this case, will the policy pay out the death benefit. Okay. Okay, so a family maintenance policy, a type of life insurance policy that provides a monthly income to the beneficiaries from the date of the insured's death until the end of a pre-specified time period. So that's saying that a family maintenance policy will pay income to the beneficiaries of the insured from the day the insured dies for a certain duration of time. So say, well, we'll give you $1,000 a month for 5 years, something like that. After the pre-selected period ends, the face amount of the policy is paid as a lump sum. Family maintenance policies offer an income for a designated period beginning from the moment of the insured's death. So for this example, say they're paying, an example right here. If Sam wants a life insurance policy that provides monthly income of $800 to his beneficiaries for 15 years after his death, and a lump sum of $25 at the end of that 15-year period, Sam should choose a family maintenance policy. This policy offers a regular monthly income starting from the insured's death and pays out the face amount as a lump sum after the pre-selected period ends. So essentially, it'll pay out income for a certain amount of time, and then at the end of that time, it pays out a big chunk of money. Next, we have family income policy. Family income policies, they provide regular income starting from the insured's death and continue for a predetermined period after the policy issuance. Example. Family income policies provide a regular income starting, if Taylor buys a family income policy at age 45 with a 15-year rider period, and Taylor dies at age 50, Taylor's family would receive a monthly income for 10 years from the date of Taylor's death. This type of policy provides an income for a period of time at the time of purchase, for a period specified at the time of purchase starting from the insurer's death. So the rider for the family income, right, lasts for 15 years. So if they die, after 5 years, then there's 10 years left for the rider to pay out. Next is adjustable life. Okay, adjustable life. Adjustable life and universal life are the same thing. Sometimes exams will call it adjustable life. Sometimes they'll call it universal life. So just remember, it's the same thing. Okay, adjustable and universal are the same. Okay. Okay. So, an adjustable life policy holder typically seeks this type of policy for flexible premium options. It has flexibility with premiums and face amounts, allowing the policy owner to adjust both as their financial needs and goals change. This combines the elements of whole life and term life into one plan. Okay, so it has, for a policy owner seeking flexibility, we'll keep reading here. For a policy owner, seeking flexibility in payment amounts and schedules, along with the ability to adjust the death benefit according to evolving life needs, an adjustable life policy would be ideal. Adjustable life policies usually do not have dividends, okay? If the policyholder wishes to increase the face amount, they may need to prove evidence of insurability. So usually if they want to increase the face amount, then they a lot of times they have to provide proof of insurability, meaning they have to show that they are healthy enough to be insured for that much more coverage. Okay. Usually people who choose adjustable life have a specific need for flexible payments. So look, Emma is self-employed and experiences fluctuating income. So she chooses an adjustable life policy to accommodate her varying financial situation. Initially, she opts for a low premium to match her current budget. As her business grows, her income increases. Emma plans to raise her premium and adjust the death benefit to align with her expanding financial goals and family needs. Universal life insurance, same thing. Ability to adjust both premiums and the death benefit. Investment gains from the policy are typically allocated to the cash value, which the policy owner can use to manage the flexible features of the policy. So, as I covered before in the previous example, as you saw, as gains were being made on the premiums that are put in and added to it, some of that's added to the cash value. Okay. All right. This is ideal for customers who want the most choice and control over their policy, as Universal Life offers flexibility in both premium payments and death benefits. Universal life policies leverage earnings to enhance the cash value and offer the policyholder the flexibility to adjust premiums and death benefits. So example, if Jordan wants a life insurance policy with flexible premiums and death benefits, where the investment gains contribute to cash value, he should choose a universal life policy. This allows Jordan to adjust both premiums and coverage while the cash value grows based on investment performance. So, main difference between universal life and whole life is that the cost of insurance inside universal life increases every year. So it's almost like there's an annual renewable term inside the universal life policy. The cost increases every year. A whole life policy, the cost is just level throughout everything, throughout the whole policy. It's all built into the whole structure, the premium and everything. Next, variable life insurance. So variable life insurance policies, they necessitate that a producer hold valid FINRA and National Association of Securities Dealers securities registration before selling any variable policy contract, including life insurance or annuities, due to their inclusion of regulated securities, like mutual funds, stuff like that, okay? So to sell variable life, this is very important, you have to have a securities registration with FINRA in the National Association of Securities Dealers. So you can't sell variable life insurance with only a life insurance license. Okay? You have to have the securities license as well and be registered with with those entities. These are known as interest-sensitive policies. Variable life insurance policies, it's a type of interest-sensitive policy. Variable life insurance policies generally feature a fixed premium, but their cash value and death benefits can change depending on how the underlying investment performs. Okay? So typically, there's a fixed premium, but their cash value and death benefits can change depending on how the underlying investments perform. Investments for variable life policies include things like mutual funds, stocks, and bonds. For ordinary traditional whole life policy, the money is put into the company's separate account. Okay? So, not separate account, the company's general account. All right. Includes variable annuity, variable life, variable whole life, and universal variable life, and also variable annuities. Variable life and variable whole life are typically the same thing, and universal variable life or variable universal life are the same thing. This is ideal for those looking to offset inflation, as these policies allow for potential growth. However, the policy owner assumes all the investment risk, and returns are not guaranteed. Okay, so the cash value, you can get gains over time, but the cash value some years may not grow as fast, and some years it could potentially shrink if the market drops a lot. So to sell any of these, you have to have a FINRA securities registration and a securities license, and an insurance license and a securities license. So over the long term, variable life will typically have more growth opportunity than traditional whole life. Example, Alex is interested in a life insurance policy where the cash value and death benefits vary with the performance of investments like mutual funds and stocks. He should consider a variable life policy. Variable life policies offer flexibility but involve investment risk, and the returns are not guaranteed. This isn't something I have a debate with, but this is how sometimes it's worded. So variable universal whole life. So blends the features of variable life and universal life policies. Typically, it would just be called variable universal life, not variable universal whole life. So just so you know, you might see variable universal whole life, but usually it should just be variable universal life. This allows the policyholder to manage the investments as well as make adjustments to when premium payments are made and how much they're for. So it's like a variable whole life policy, except it's just universal life. So it lets someone have more control over the policy's financial aspects, like which investment accounts to fund, when premiums are paid, where investment returns are allocated. And the policyholder can adjust both the premium payments and premium schedule and the amount, potentially adjust the face amount too. So remember how we talked about how universal life, you can adjust the premiums and the face amount. So in universal life, we'll talk about this for a second here. In universal life, there is a target premium, okay? A target premium. The target premium is here, let me just look this up because I always get confused on this. So target premium, universal life. So yeah, so this is how much the insured should pay. The policyholder should pay to ensure that the policy remains active and adequately funded for its entire duration. Okay? So that's the target premium. Now, there is another type of premium or another name for a premium. There's a minimum premium, which is the minimum amount that the insured needs to pay that premium schedule time to keep the policy in force. So say to keep the policy in force for the desired lifetime, the client needs to pay, $280 a month. But maybe just for this payment to keep the policy in force, they need to spend $70 or something like that. That's the difference. And then there's a maximum premium that can be paid in to where the policy is max funded. Then they can't pay any more than that into the policy. So those are some of the differences with premium in universal life. You have the minimum premium, which is the minimum amount they need to pay to keep the policy in force. There's the target premium, which is how much they should pay to keep the policy in force through the policy's lifetime. And then there's the maximum premium, which is the maximum amount that they can pay into the policy. So example of a VUL here. If Emma wants a life insurance policy where she can control not only the timing and amount of her premium payments, but also how her cash value is invested, choosing between various investment accounts like mutual funds and stocks, she could consider a variable universal life policy. This type of policy combines the features of variable life and universal life, allowing Emma extra flexibility in both premium payments and investment choices. Okay. So variable universal life, it's a universal life policy where the underlying investments of the policy are based in stocks, in bonds, in mutual funds, and not in the company's general account. So if it was a regular universal life policy, the gains will be the company's risk, right? The company takes the risk in saying, "Hey, we're gonna invest this money in the right place for you." So the investments are usually a lot more conservative because the company's looking out for itself in the long term. Variable universal life and variable life allow people to be a little bit more aggressive to get those longer term gains potentially. Okay. Equity index universal life or equity index life or index universal life. This blends the security and benefits of traditional life insurance with the potential for higher returns linked to an equity index. So this is like a universal life is a policy where it's a universal life policy where the underlying investment is linked to it's not directly impacted by mutual funds and stuff like a variable life is, but it's linked to an index so that if the Dow Jones Industrial Average, so if the stock market does well, then this policy will do a little better, right? It may not be able to perform as high as a variable universal life would, but also it has a guaranteed minimum interest rate paid out as well so that they can't lose. Okay. So right here, guarantees a minimum interest rate, tax-deferred interest accumulation, and access to policy loans. Designed to match or outpace inflation, these policies protect against downside market risk while offering the growth potential of the equity index. Combines term life insurance with an investment component, much like a universal life plan. Okay. Next, we're looking at investor or stranger-oriented or originated, life insurance policy. So an SOLI, it's usually STOLI, STOLI, or IOLI. Investor is an IOLI, stranger is STOLI, STOLI. In this policy, an investor benefits financially from the death of the insured rather than a beneficiary with an insurable interest, which is typical in ordinary circumstances. So this involves when an investor purchases a policy in another person's life with the intent to profit from that person's death. So essentially we'll look at here, we'll look at STOLI example, STOLI. We got me, and then we got Jeff Bezos example, right? So I cannot get a life insurance policy on Jeff Bezos to profit from his death because I have no insurable interest in him. Like if he dies, it doesn't really impact my life except for maybe I don't have someone to learn how to get successful from, and I don't have, and maybe Amazon would have some changes or something like that. But, it's not like it's going to directly impact my finances. So typically what happens is the insured receives payments usually during their lifetime. So it's essentially like someone buys a policy in someone else's life to profit on it, and the person who's the insured often receives some sort of payment or remuneration. So we'll look here. Here, what we got here. Okay. If Alex, an investor, purchases a $100,000 life insurance policy on Jamie, the insured, and names himself as the policy owner and beneficiary, Alex would receive the $100,000 benefit on Jamie's death. Alex owns the policy. He's the beneficiary. Jamie is the insured. Jamie, in exchange for allowing this policy, receives $500 a month. This type of policy, known as investor-originated life insurance, is illegal because it bypasses the insurable interest requirement, allowing investors to profit from the death of someone they have no personal stake in. So you can't get a life insurance policy just to profit off a stranger's death. Cash value. The cash value refers to the equity or savings within a whole life insurance policy. So cash value is the cash accumulation within a whole life insurance policy. It's a big feature of whole life insurance policy. Sometimes cash value can be eligible to receive dividends or in earned dividends or not. So it depends if it's a participating or non-participating policy. Example, Sarah has a whole life insurance policy with a cash value. After 10 years, her policy's cash value has grown to $15,000. She uses this amount to take out a loan for home renovation. So Sarah could dip into that cash value, take a loan out against it to renovate her home. And she can, pay it back over time. So I have more videos on all these topics that go a little bit more in depth into them, because what this is just basically covering is the vocabulary, the definitions of each of these terms. And some of the bigger concepts are found in my other videos and also in some other courses that we offer. Okay. So we have endowment policy. Okay, endowment policy. An endowment policy provides for payment of the face value at the end of a specified period upon reaching a certain age, or upon the death of the insured's death, before the specified period ends. So it provides for payment of the face value at the end of a certain period upon reaching a certain age or the insured's death. So it's like, example, John purchases an endowment policy with a face amount of $50,000. The policy specifies a maturity period of 20 years. If John is alive at the end of that time, he'll read $50,000. If he receives it before then, they receive $50,000. So an endowment policy, it's kind of like a whole life policy where the maturity date of the policy is shrunk. So it doesn't take as long for the policy to mature. So for example, a normal whole life policy, someone would have to live to 100 to get the benefit if they don't die. In an endowment policy, it's something where they would be able to get that money beforehand. And obviously, they don't have to keep making premium payments after they get that benefit. Next, face amount plus cash value policy. A face amount plus cash value policy guarantees a payment that includes both the policy's face amount and an additional sum equivalent to the policy's cash value upon the insured's death. Example, Sarah has a life insurance policy with a face amount of $30,000 and a cash value of $5,000. If Sarah passes away, her beneficiaries will receive a total of $35,000, which includes both the face amount and the cash value. So normally when someone dies, they do not, that's like usually with universal life. Normally if someone dies, they only receive the death benefit. They don't receive the cash value on top of it. Okay, so most policies, the insured only receives the death benefit. They do not receive they do not receive the cash value on top of it. But if you want that, then it costs more money for that policy because they're paying extra benefit. So what we'll do, I'll just give you an example. Where's the whole life policy? Okay, well, we'll say this is a whole life policy. So we're going to look at, say this is a whole life. Here's the premium being paid right here in red, and this is the cash value increasing, and this is the death benefit. Most of the time, if the insured died, if say the insured died right here, only the death benefit would pay out. Okay? In a face amount plus cash value policy, this would pay out plus this amount. All right? When the death benefit reaches the cash value, which is by age 100 typically, but so I did the drawing to scale, not the right scale here, right? Because 100's here. But when the death benefit reaches the cash value at age 100, that's when the policy endows. Okay? That's why there's equity in the policy, because essentially the company doesn't have to pay out as much from their own coffers to pay the claim as there's more cash value, right? So that's why it would cost a lot more money to have a death benefit plus cash value policy. Okay. Juvenile insurance. These are life insurance policies for children with certain age limits, typically while they're still under parental authority. So juvenile policy, it's a policy on a kid. Non-medical life insurance is a type of life insurance policy that does not require the policyholder to undergo a medical exam, although it generally costs more than medically underwritten policies. They will evaluate their medical history and lifestyle to assess risk, even if no exam is required, and will adjust premiums accordingly based on the average risk. Okay, so they can cover a broader range of risks without individual medical assessments. Okay. And then target premium, we covered that. A target premium is a recommended amount for universal life policies established to help indicate what is needed to maintain the policy under conservative estimates. Does not ensure there will be enough funds to keep the policy active indefinitely, including throughout the insurer's lifetime. For a universal life policy, the insurer might suggest a target premium of $2,500 annually. This is an estimate to keep the policy active, but it doesn't guarantee it's going to be there forever. Okay? So this is an estimate of, hey, this is how much you should pay to keep the policy active for however long the person wants to keep it active for. They'll have universal life policies where, say, I want it to be active until I'm 90 years old. Okay, you're going to have to pay this much. I want it to be active until I'm 80 years old. Okay, you're going to have to pay this much. 70 years old. Okay, you're going to have to pay this much. So that's part of the flexibility that comes with universal life policies. That premium will impact. Remember in the graph I showed, right, where the cash value, I don't know if I still have it or if I erased it. Yeah, I erased it. But where the cash value will grow in the early stages of the universal life policy as the insured is typically paying in more. So say this $2,500 will be more than what the policy costs internally. Then over time, the internal cost will exceed that. So the difference has to come out of the cash value. So depending on how much they pay will determine how long the policy lasts, because it'll let the cash value grow at first so that there's more in there to help later on when the premium is not enough to cover the actual cost of the policy. Okay, I am getting so sick of vocabulary, but I'm still here. So if you can hear my voice, I'm kind of sick, but I'm really getting sick of vocabulary, but whatever. It's all good. I'm sure you guys are too. We're going to rock this out here, and we're going to make it happen. So next, we're going to be talking about some of the riders, options, provisions, all that good stuff for life insurance policies. Okay. Absolute assignment. Thank you guys for rocking with me too. I know this is a lot. Like, man, when I was studying for this, I was so annoyed. I was like, dude, these words are, some of it was cool, but a lot of it was so boring. I was like, man, I cannot wait to just sell insurance. And it gave me a different opinion of my friends who are lawyers too. Because I was like, man, you guys actually like this stuff, but whatever. Some of this stuff was cool. Don't get me wrong. But sometimes I was just like, oh my gosh, I'm ready to take this test and pass it so I don't have to read this material anymore. Okay. Absolute assignment refers to the complete transfer of ownership rights and control over an insurance policy from the original owner to another person known as the assignee. So this is when you absolute assignment is a complete transfer of rights. It's a complete transfer of rights. So this means when the new person becomes the owner, they have access to cash value, they can change the beneficiaries, all that stuff. In situations where the policy is used as collateral for a loan, the original owner retains any rights exceeding the debt amount, even if the assignment appears to be absolute. So that's called a collateral assignment. So if someone has a loan, we'll bring over my handy dandy whiteboard here. So say someone has a loan for $100K. Okay? They got a loan for $100K. Now, they say they have a $200,000 life insurance policy. Okay? $200,000 policy. Okay. So they can assign, if we got me, I got hair now. I got a transplant, so we got to fill it in there. Got to give credit where credit's due. Then you got me feeling cool with my loan and my policy. Super happy about my situation. Now, what I got to do, I got the loan, but we got the bank. The bank. So me, I have to assign ownership, collateral assignment, CA, collateral assignment. I give the bank ownership of $100,000 worth of this benefit. Okay? So the bank has rights to that amount. As I pay down the loan, the amount that they have a right to decreases, right? Because that whole amount isn't what I owe on the loan anymore. Okay, hope that helps you understand collateral assignment. And then after that's paid off, the assignment goes back to me. Okay, and then the bank is no longer assigned it. I have full ownership again. Okay. I like how I drew my picture there. Okay, accidental death benefit. This is a rider. It's called the multiple indemnity rider. An accidental death benefit rider provides an extra payment to the beneficiary if the insured's death results from a covered accident. This extra payment is usually a multiple of the policy's face value, such as 2 or 3 times the original amount, offering the most cost-effective way to increase coverage temporarily. So, example, Emily has a life insurance policy with a face value of $100,000. She has an accidental death benefit rider that pays out double the face amount. If she dies in an accident, her beneficiaries receive $200,000. So we'll look at the illustrations here. Okay, so we got Emily. She's feeling cool with her policy. She's like, I'm going to get an accidental death benefit rider. Okay, so say Emily is here. She's all happy, and then one day she has a heart attack, and she's not here anymore. Her family, since that's a natural cause death, will get say she had a $100,000 policy. Her family will get $100K. Now, in this other situation, Emily's going along, and say an asteroid falls from outer space and takes Emily out of the equation. Emily gets killed by an asteroid. It's an accident, right? So in that case, as long as it's a covered accident, her family would get $200,000 if it was a double indemnity accidental death rider. Okay. Accelerated benefits rider. The accelerated benefits rider allows the policyholder to access a portion of the death benefit while still alive if diagnosed with a terminal illness expected to result in death within 1 to 2 years. Depends on the state. The amount taken in, I don't think you need to know that, your state-specific stuff, but that's just to know. The amount taken in advance reduces the total death benefit available to beneficiaries. It actually has to do with the state or the carrier that's selling, the insurance company. Example, Maria is diagnosed with a terminal illness and has a life insurance policy with a $500,000 death benefit. She uses the accelerated benefits rider to access $200,000 for medical expenses. When she passes away, her beneficiaries will receive the remaining $300,000. So, for example, we'll do here. So say she's got a $500,000 policy. Okay, so we got $500K. So we'll go here. So she's got $500,000. Okay, $500,000. And then one day she's diagnosed with a terminal illness, TI, terminal illness. So say she has terminal cancer, stage 4 cancer, or something like that. Doctor says you're going to die in 8 months, something like that. So she says, okay, well, I want some of this money ahead of time. So I want you to give me whatever it was on there, 300,000 now. I forget the exact example, but 300K now. And then later, once she dies, her family gets or her beneficiaries get the additional 200K. Okay? So that's how the terminal illness rider works. Or it's also called an accelerated benefits rider. Accumulate interest option. So this has to do with dividends. Dividend options. The accumulate interest option lets the policy owner leave dividends where the insurance company to earn interest over time. Okay? So the interest earned is taxable as income for the policy owner. Okay. So David earns dividends on his participating life insurance policy through a mutual insurance company on his whole life policy. Say it's earning dividends. David chooses to let his dividends accumulate at interest. So the insured holds them. They accumulate at interest. Okay? The dividends earn $200 in interest, which David will need to report as taxable income. The dividends aren't taxable, but the interest is. There's an acronym you can use to learn your dividends as well. Okay? So you can do CAPPO. Okay? CAPO. Okay? CAPPO. It's cash, accumulated interest. I'm going to have you guys so you can see this. Accumulated interest, paid up additions, premium reduction, and then 1-year term. Capo. Okay? Give you guys a second there. Okay. We'll get into those more in depth in here. But one of them, accumulated interest. We're going to go here. Accumulated interest. We got the company. Insurance company. ABC Insurance Company. Okay, and they pay out a dividend to John. This is John's dividend. Okay. John's here. John's pumped. He's like, yo, give me my money, dude. Here's John. He's got his dividends coming. Okay. And he's like, you know what? I'm good. I'm going to send it back to you to hold. And then I want you to pay me the interest that you earn. And the money's going to stay here, but then those little pieces of interest are going to go back to John. That is the accumulate at interest option example. So instead of him taking the dividend, he lets the company hold on to it, and then they invest it, and then they pay him the interest earned on the dividend, and that has to be declared as taxable income. Okay. Assignment clause. The assignment clause in an insurance policy, these are in ABC order. I know it's kind of all over the place, but it's hard to put them in perfect order for every subject because they like cross over. It's like I could talk about cash value here, I could talk about it before, so it's hard. Assignment clause. The assignment clause in an insurance policy permits the transfer of policy rights to another party. Example. Sarah assigns her life insurance policy to her business partner as part of a buy-sell agreement. This ensures that if Sarah passes away, her partner will receive the policy benefits to fund the purchase of Sarah's share of the business. So in the assignment clause, it means it says you can transfer rights. You can assign the rights and ownership of the policy to someone else. Okay. Automatic premium loan rider or provision. The automatic premium loan provision allows the insurer to cover a missed premium payment by borrowing from the policy's cash value at the end of the grace period. So the grace period is a period of time after you miss a payment, after the payment is due, that you can still make the payment without your policy lapsing. In other words, if you miss a payment, the insurance company can automatically borrow against your cash value to cover the premium. This loan continues automatically until the policy owner starts making payments again or the cash value is depleted, at which point the policy will lapse. Example, Alex misses a premium payment on his life insurance policy. The insurer uses the automatic premium loan provision to borrow from Alex's cash value to cover the payment. This keeps the policy active until Alex starts paying again or the cash value runs out. So I'll show you in a quick example. Then we'll get back to the dividends. So say there's the cash value, okay? And then there's the premium, okay? If the premium is missed, a certain amount of time will elapse, say 30 days, if it's a 30-day grace period, that the insured can still make a payment, okay? If it's still not paid by then, and there's enough money in the cash value will cover the premium, and that amount will be reduced from the cash value as a loan. Will be taken out as against the loan. So it's not double. It's just, we'll just put it here. So that would make you think maybe it's double, but it's not. So here, loan to cover the premium. Okay. Gonna erase all this stuff here. I don't know why I'm doing that, but I'm just taking up extra time. Okay. Next, we're looking at the cash option. The cash dividend option permits the policy owner to receive their dividends in cash payments. Example, after his life insurance policy generates dividends, Tom opts to receive the dividend amount directly as cash rather than reinvesting it. So if we go here, remember how before, rich homie Alex, we'll use Alex, he was like, dude, I got enough money. I don't need my dividend, dude. You keep it. Just pay me the interest because I got it like that. If that's sometimes, maybe Alex is like, you know what? I kind of want that money right now. So what happens in this case? He says, it's my money and I want it now. So now Alex has the dividends in hand. He's got that cash to go do whatever he wants. Okay. Cash surrender option. The cash surrender non-forfeiture option. This is a non-forfeiture option. So there's also non-forfeiture options. So there's dividend options and then non-forfeiture options. Okay? Non-forfeiture options. Okay. So the cash surrender option lets the policy owner take the policy's cash value. After this, the policyholder no longer has insurance coverage. By law, insurers can defer paying the cash value for up to 6 months. Example, after holding his life insurance policy for several years, Jim decides to terminate it and chooses the cash surrender option to receive its accumulated cash value. Okay. All right. My power's flickering on and off here. So I might lose service. Okay, here we go. So next is the other options are extended term insurance and reduced paid up insurance. So REC, we'll cover that in a second, but REC. The R is going to be, well, I'll just do this here. The R is reduced paid up. E is extended term. C is cash surrender. Get all the money. Buy term with the money. And this is buy whole life with the money. Okay. So if you want to take notes on that, I'll give you a second. And if you don't have enough time, I will do that. Okay. So, collateral assignment, we talked about that already. That's where instead of absolute assignment and collateral assignment, we're transferring rights of an insurance policy to a creditor as collateral from the loan. Once the loan's paid off, the assignment goes back to the insured or the owner of the policy. If the insured dies, then whatever is in excess of the loan amount gets paid to the other beneficiaries of the policy. I don't know where my water is. Okay. Consideration clause. The consideration clause requires the policy owner to pay a premium to secure the insurer's commitment to provide benefits. So the policy owners, we covered this earlier, but the consideration involves submitting the application and paying the initial premium. So essentially in the consideration clause, this specifies that how much you pay, how much he's going to pay a month, or how much he's going to pay, how frequently he's going to pay, and his application. So John's life insurance policy contains a consideration clause which specifies he must pay a monthly premium of $100 in exchange for the insurer's promise to pay the death benefit to his beneficiaries. By submitting his completed application and initial premium payment, John fulfills his part of the agreement under the consideration clause. So details about the amount and frequency of premium payments are outlined in the consideration clause. The policy owner's consideration involves submitting the application and paying the initial premium payment. So that's saying, here's my application, here's my health history, here's my premium, please consider me for insurance. Okay. Next, we have dependent riders or other insured riders. Okay. Dependent riders allow individuals, typically family members, such as spouses and children, to be added to the primary policy as insured. So we covered this before in term riders. Dividend options. Dividend options refer to the various choices a policyholder has for utilizing dividend payments from their insurance policy. Remember, CAPO, CAPPL, cash, accumulated interest, paid up, so cash, they just get the money. Accumulated interest, that's where they get, the insurance company keeps the dividend and pays the interest to the policy owner. Paid up additions, we'll get into that. We'll get into premium reduction in 1 year term. Quickly though, paid up additions is just when that dividend is used to buy additional whole life insurance that allows the policy to grow. That's like the most popular one. This will allow cash value to grow faster because it'll compound over time, because that new additional whole life policy, the really small face amount, will accumulate dividends as well, so it snowballs. Premium reduction, this is when your dividend goes to paying your next premium, so it just reduces the amount you need to pay. And then 1 year term, this is when the dividend buys a policy for extends the term coverage for 1 year. So it buys a 1 year term policy, like essentially like a 1 year term rider almost, but like a 1 year term policy for however much insurance the dividend purchases it for. Entire contract provision. So the entire contract provision states that the insurance policy, along with any attached riders, endorsements, and application, constitute the complete agreement or entire contract between the insured and the insurer. So the insurance policy, the application, and any riders, endorsements. Okay, so if you want to come up with an acronym for that, we can. So it'll be like entire contract, we got the policy, endorsements, riders, application. So pair. Entire contract, pair, P-E-A-R, right? P-E-A-R. P-E-A-R. Policy, endorsements, application, riders. Okay. When reviewing his policy documents, Kevin notes that the entire contract provision ensures that no outside documents or verbal agreements can alter the terms of his policy. Exclusions. Exclusions are specific conditions or circumstances outlined in an insurance policy that are not covered by the policy. Maria's life insurance includes an exclusion for death caused by participating in dangerous activities like skydiving. If Maria dies while skydiving, her beneficiaries would not receive the death benefit. So one way to remember exclusions is WASH. So it's war, aviation, suicide, and then hazardous activity or job. Okay, so WASH exclusions. You want to take a second to write that down. Okay. Extended term. So this is one of the REC non-forfeiture options. So with extended term non-forfeiture brain fart there. With extended term non-forfeiture option, the policy owner can apply the policy's cash value to obtain level term insurance coverage for a set duration with no further premium payments required. The coverage's amount is equivalent to the net death benefit of the original policy. So say the net death benefit is $100,000. Oh, example. When Paul can no longer afford to pay the premiums on his whole life insurance policy, he chooses the extended term option. The insurer uses the policy's accumulated cash value to purchase a term life insurance policy with the same death benefit, but coverage will only last for a specified number of years, depending on the cash value. This allows Paul to maintain coverage for a limited time without continuing premium payments. So I'll give an example here. So say there's $100K in cash value, okay? And it's a $1 million term or $1 million whole life policy, okay? So $1 million whole life. So what happens is we have that $100K in cash value, and that will purchase. He says, no, that's for part of my non-forfeiture option. I want to stop making payments and I want to get rid of my policy, but he still has some value left over. So he's like, I'll take some term, some extra term. So what happens is this $100,000 goes to purchase. What this does, it becomes a $1 million term policy. And depending on how old the insured is and their health rating and everything else, that will determine the duration of the term policy. So maybe that $100,000 will buy a term for 20 years or 30 years or whatever it is, or 27.62 years, something like that. But that money is used to buy a $1 million term policy, and then it lasts for however long that amount of money will buy a term policy for. Okay? Okay. Free look period. Free look period gives the policy owner a set number of days after the policy is delivered to examine it and return it for a complete refund of premiums. So they get to look at the policy for free. Okay, free look, you get to look at the policy for free. After purchasing a life insurance policy, Jane has a 10-day free look period during which she can return the policy for a full refund if she's not satisfied with the terms. So the reason why I have that is because sometimes people aren't always approved as applied for life insurance, right? So say someone applies for a preferred rate and they get approved at a standard rate. Well, they want time to review the policy and make sure they want to keep it. So she has 10 days to review the policy. And there are some rules around when the free look period starts. Typically, it's when the agent delivers the policy or when they receive the policy in the mail. Typically, it's like one of those days. A lot of times, it'll be when the delivery receipt is signed, but if people are mailed policies, they don't always get a delivery receipt signed. So, grace period. We covered this, but the grace period is the time allowed for the premium due date during which the policy stays active without any payments. So it's like we'll cover an example here, but if the insured passes away during the grace period without paying the premium, the annual premium or the premium, the beneficiary will receive the policy's face value minus any unpaid premiums. Typically, the grace period for life insurance is 1 month. Mark's life insurance premium is due on the first of the month, but he has a 30-day grace period to make the payment. If he passes away on the 15th without paying, his beneficiary will still receive the death benefit minus the overdue premium. Okay. So essentially, it's due on the first of the month, but he's got 30 days to make a payment. And after that, if there's no money to cover it in the cash value, then the policy lapses. Okay. Guaranteed insurability rider, future increase options. So what this allows you to do is add insurance. So it allows the policyholder to add more permanent life insurance at specified times without having to prove insurability. It also covers certain life events, such as marriage or the birth of a child, without requiring additional proof. Generally, this can be used every 3 years, allowing for increases in coverage up to the initial policy amount. So say the insurer, the policyholder with the guaranteed insurability rider. Here. This is an example. So Lisa's life insurance policy includes a guaranteed insurability rider. When she has her first child, she exercises the option to increase her coverage without having to undergo a medical exam or prove insurability. A few years later, she uses the rider again to add more coverage when she gets married, ensuring her family has additional financial protection as her life circumstances change. Incontestable provision or incontestable period. Incontestability is also called. This states that after life insurance has been active for a certain period, usually 2 years, the insurer cannot dispute its validity. Case law has established that the incontestable clause also applies in instances of fraud. So after Dan's life insurance policy has been enforced for 2 years, the insurer cannot challenge the policy's validity or deny claims based on misstatements or omissions in the application. So after the policy's been in 2 years, it has to pay. The insuring clause or insuring agreement. The insuring agreement details that the insurer's primary promise to pay defined benefits to a specified person if a covered loss occurs. So this sets the coverage's extent and limits while essentially saying we guarantee coverage for, if you die. So in the insurance clause of her policy, Maria's insurer agrees to pay a death benefit to her beneficiaries if she passes away while the policy is enforced. So it says, hey, we will pay money to whoever you want us to if you die while the policy is in force. Okay. Misstatement of age or sex provision, or misstatement of age and gender. This provision enables the insurer to modify the policy benefits if the insured's age or sex is incorrectly stated on the application. Benefits are recalculated based on the correct information. So this is gender at birth. So if the insured's actual age is older than reported, the benefits will be reduced accordingly. Conversely, if the insured is younger, the benefits will be adjusted upward. If the person is found to be applied as a female and as a male, then the death benefit will be lowered because men have a higher risk than women in general. If this is discovered while the policy is in force, they usually just adjust the premiums. But if it's discovered after they pass, then they adjust the death benefit. That's typically what I've read. That's like what I've read what happens. Okay. Non-forfeiture options. We covered those, but these options are the choices available to a policyholder regarding their use of the policy's cash value if they decide to terminate a policy with a cash value component. This option ensures the policyholder does not lose the accumulated value. Essentially, if you're closing your account, which is surrendering, this is a metaphor, but if you're closing your account, which in insurance terms is surrendering your policy, you'll need to decide what to do with the cash value after losing the policy. When a policy owner chooses to terminate their policy, they have the option to surrender it. When Alice decides to end her whole life insurance policy, she can choose a non-forfeiture option to either take the cash surrender value or use it to buy extended term insurance or use it to buy something else, which is reduced paid up insurance. So reduced paid up insurance is, it's got to be on. Yeah, it's down there. But reduced paid up insurance is when it takes that cash value and buys a permanent whole life policy for whatever face amount it'll buy, that value. But we're just going to cover the basic premise of non-forfeiture options here. So say we got a policy. Once again, we have money over time. And then we're going to look at the cash value here. So say there's this cash value. Cash value is growing over time in this policy, okay? We're only looking at the cash value here. Cash value is growing over time. Now, at this point in time, the person says, well, right here, they're like, nope, okay, I want to cancel my policy. Well, this is equity, okay? So it's like if you sold a home and you had this much and you had this much positive equity in your house, even though you still have a loan, you sell it, you owe less, or you owe less than the house is worth. So the house is worth more than what you owe on it, right? So you get the difference if you sell it. For a whole life policy, there's equity, so the policy has a value. So if you cancel it and you have your cash value, it doesn't just disappear. You can do something with this. So you can we'll go this way. Remember, we have cash surrender. We also have extended term. And then we have reduced paid up. So REC, okay. So this is, you just get the cash. This is when you have term insurance for a certain amount of time. So it'll buy a term policy for the face amount and then end, goes away. And then this is when you have reduced paid up, that should be a U, so it looks like a V, reduced paid up. It's when it uses to buy a smaller whole life policy that you never have to make another payment on. So say this is the death benefit on this policy, that amount of cash value, might buy that much whole life insurance or whatever the case is, right? So those are the three main non-forfeiture options. Okay. Okay. 1 year term option. This is for dividend options. Remember, for dividend options? Remember our dividend options, everybody. I thought I had that here somewhere. Notes. Yep. Dividend options. So CAPO, CAPPO. 1 year term. So the 1 year term dividend option lets the policy owner use their dividends to purchase additional coverage through a 1 year term policy. Instead of taking his dividends in cash, Bob uses them to buy a 1 year term policy, increasing his total coverage for the next year. Paid up additions. It's another dividend option. CAPO, CAPPO, cash, accumulated interest, paid up additions, premium reduction, 1 year term. The paid up addition option lets the policy owner use the dividend to purchase an additional whole life policy with a single premium payment. Mark chooses the paid up additions options for his whole life insurance policy. Each year, his dividends are used to purchase additional small whole life insurance policies, increasing his overall death benefit without requiring extra premium payments. These paid up additions also build their own cash value, adding to the growth over time, and they also earn dividends. This is important to understand. If you guys are getting into any sort of financial advising, this is a big thing. So let's look here. So we got, once again, money over time, and we're looking at the cash value. So say right here, say there's the face amount of the policy. So we're looking at the face amount of our participating whole life policy. It might increase over time because it's participating in dividends. Because what happens is this earns a dividend right here. Say that a dividend is earned right there. That dividend through paid up additions is earned to buy another policy that increases the face amount. Then another dividend is earned right here. It does it again. And then another dividend is earned right here. It does it again. So the face amount keeps increasing because there's little small whole life policies that are being purchased with the dividend to add to the main policy. And then it would actually increase more like this. It increases like exponential. And then it gets to a point where it just starts really snowballing. It's like a snowball effect because then all these little ones will increase over time, will add up, and then that one from before is still creating more dividends, right? So it just kind of all snowballs and accumulates. And then all these that are earning dividends are even adding. So like these ones here that are earning dividends are going to be adding more insurance there. So it just increases, and it has a compound effect. Pay your provision, rider or clause. If the individual responsible for paying the premiums on a juvenile policy dies or becomes disabled, this provision waives all future premium payments, ensuring the policy remains in force. So this means that if some guy has, say Johnny has a policy on his son, and John dies, if John's the payer, his son, if John's the payer on his son's policy, he doesn't have to worry about his son's policy lapsing. The payor provision means that like with Susan, if Susan becomes disabled or passes away before her son reaches adulthood, this will waive all future premiums, ensuring the policy remains in force without requiring further payments. And it'll remain in force even after the kid reaches maturity. Okay, policy loan, cash withdrawal provisions. These provisions apply to cash value policies, allowing the policy owner to take out loans or withdraw cash from the policy. These policies are required to start accumulating cash value after a specified period, typically 3 years in most states, so they have to within 3 years. Some accumulate sooner. Those limited pay policies we talked about, or single premium whole life policies, those typically accumulate cash value faster and sooner. These loans are not subject to tax, and any outstanding loan amounts plus interest are deducted from the policy proceeds upon the insured's death. Loans including interest cannot exceed the policy's guaranteed cash value or the policy will lapse. So you can't take out more than the cash value as a loan because it's a loan against the cash value. The cash value is the collateral for the loan. It's like taking a home equity line of credit. Okay. Okay, example, Mike's whole life insurance policy is a built up cash value over several years. When he needs funds for an emergency, he takes out a policy loan against the cash value, which is not taxable. The loan plus interest will be repaid over time. However, if Mike passes away before repaying the loan, the outstanding loan amount and interest will be deducted from the benefit his beneficiaries receive. Okay, so that's cash value, loans on the cash value. Okay, reduced paid up option. Well, again, another dividend option, remember? REC, you want to be me because I got cash value. REC, right there. Reduced paid up. This non-forfeiture option allows a policy owner to stop paying premiums in exchange for a reduced benefit amount. The policy remains in force, but the face value is decreased. When Sarah can no longer afford her whole life insurance premium, she chooses the reduced paid up option. This reduces her policy's death benefit, but she no longer has to make premium payments. Her policy remains in force for the rest of her life with the reduced benefit amount using the cash value that had already been built up. Okay? So she purchases a reduced face amount policy with her cash value. So she takes all that equity. Remember we were talking about this equity right here? Say her death benefit was up here before. That cash value there might buy a whole life policy its death benefit is there, but she never has to make another premium payment on it. Okay? And it can earn dividends and all that stuff too. Okay. Reduced premiums option. So this is a dividend option, remember? Under this dividend option, I thought I had capo. 1 second here. Let me find my notes. Yeah, capo. Premium reduction or reduced premiums, okay? Under this dividend option, the policy owner can apply the dividend towards reducing the following year's premium payments, lowering the overall cost of maintaining the policy. David's whole life insurance pays annual dividends. This example. Listen closely. He chooses the reduced premium option using his dividends to lower the next year's premium. Instead of paying the full premium amount, David's payment is reduced by the dividend amount, helping him save on his annual premium cost. So essentially, the dividend just goes towards paying the next premium. Okay, reinstatement provision. Reinstatement involves restoring a lapsed policy by providing acceptable proof of insurability and paying any overdue premiums. Okay? This allows the policy owner to reactivate a lapsed policy provided they can demonstrate insurability and settle all past premiums, outstanding loans, and accrued interest. Example, Jane's life insurance policy lapsed after she missed several premium payments. A few months later, she decides to reinstate the policy. To do so, she provides proof of insurability, pays all past due premiums, and settles any outstanding loans and interest. Once these conditions are met, her policy is reinstated and back in force. You use the force. Return of premium rider. The return of premium rider provides a refund of all premiums paid into the policy, plus the face value if the insured dies within a specified period stated in the policy. Okay? Additionally, it may refund the premiums to the insured if they outlive the specified period. So John purchases a term life insurance policy with a return of premium rider. If he passes away within the term, his beneficiaries will receive not only the face value of the policy, but also the premiums he paid over the years. If John survives a 20-year period, the rider allows him to receive all the premiums he paid back in a lump sum. So it says you're going to get your death benefit plus all the money you paid in. And if you outlive the policy, you're going to get all the money you paid in. Why would the company pay back the money they paid in? Well, because as John's paying his premium, the company is investing it in their own accounts to earn interest. So they make a profit off his money. Okay. Suicide clause. This is actually usually costs more money. So this rider costs money. This is not a free thing. Return of premium policies cost more than those that don't have return of premium. Suicide clause. This clause voids the policy and denies the death benefit if the insured commits suicide in the first 2 years after the issuance of the policy. This provision is intended to protect the insurer from applicants who purchase a policy with suicide in mind. Example, Mark purchases a life insurance policy which includes a suicide clause. If Mark were to commit suicide within the first 2 years of the policy, the insurer would not pay the death benefit to his beneficiaries. After the 2-year period, the policy would pay out the full death benefit even in the case of suicide. The clause is designed to protect the insurer from people taking out policies with the intent of committing suicide after. Waiver of premium. This rider allows the policy owner to stop making premium payments if they become disabled while the policy remains active. It's not a loan, nor does it provide cash payments. Instead, the insurer simply waives the premiums as if they were being paid regularly. Did we cover that enough here? Yeah, so if someone can't buy a policy and commit suicide for someone to get a benefit, they got to wait 2 years. Hopefully by that time they found the help they need and they don't feel that way anymore. Waiver of premium rider. This allows the policy owner to stop making payments if they become disabled. So we cover that. It's not a loan, nor does it provide cash payment. It simply waives the premiums as if they were being paid regularly. So it allows the company to just, if someone becomes disabled, the insurance company will waive their monthly payments. And it says that in the example there. So that person's policy will stay in force if they become disabled. There's certain rules around disability waiver of premium riders and how long they need to be disabled before it kicks in force. Just like if you're studying for your life and health insurance exam or your health exam, there's there's riders about that, or details about you have to can't. It's not like oh, I'm disabled today, so I get the money. It's usually like some sort of a period that it takes before it kicks in. Okay, so we're going to cover some of the vocabulary in group life. I hope this video is providing some value to you guys. This is just about everything you need to know for the vocabulary for your pre-licensing exam. So this is like most of the stuff you're going to be tested on. What I'm covering here is most of the general insurance content too. Most of this content applies to life and health, and maybe other types of insurance as well, except for the life insurance specific stuff, obviously. Blanket health policies. Blanket health policies are designed to cover a group. Now, this is some health thing, but this was just on there. So, this is designed to cover a group exposed to similar risks with a constantly changing membership. These policies may be issued to entities such as airlines or schools to cover passengers or students, respectively. Unlike group insurance, blanket health plans do not provide individual certificates of coverage. Example: a university purchased a blanket health policy to cover all students participating in sports events throughout the academic year. Okay. Certificate of insurance. A certificate of insurance is a document provided by an insurance company or broker that verifies coverage under specific conditions for listed individuals. In group insurance, the policyholder is the employer or or whatever other organization owns the policy. That's who maintains the master policy, while the insured employees receive a certificate of insurance instead of an individual policy. Example: when Jake started his new job, he received a certificate of insurance confirming his coverage under the company's group health insurance plan. So, in group insurance, there's a master policy, and if you fall under the master policy, then you get a certificate of insurance instead of an individual policy. Contributory plan. This is a type of group life insurance. So a contributory plan is a group insurance plan where both the employer and the employees share the cost. Usually, at least 75% of eligible employees must participate in the plan. Employees contribute to the premium payments. Example: the company's health insurance was a contributory plan, so Emma and her coworkers each paid a portion of the premium along with their employer. Conversion privilege. The conversion privilege allows a policyholder to replace an expiring insurance policy with a new one, continuing coverage without proving insurability. Okay. Conversion can be based on the insured's attained age at conversion, or the original age at the initial policy issue. This option is common in term life and group life insurance policies. When Jack left his job, he used the conversion privilege to switch his group life insurance to an individual policy without needing to prove his health status. Okay. So this is just where someone can convert their group life insurance into an individual policy. Okay. Credit policies. Credit policies are intended to assist the insured in repaying a loan if they become disabled due to an accident or illness, or in the event of their death. In the event of disability, the policy supplies monthly benefits that are equivalent to the required loan payments. So sometimes we talked about credit policies, but essentially these could cover everybody who gets a loan through a credit union. So that's why this is a group policy, because credit unions might have group plans that people can take out that help cover loans. Franchise insurance is a life or health insurance plan that covers individuals groups of individuals with separate policies that have uniform provisions but may vary in benefits. These policies are typically solicited within an employer's business with consent. Franchise insurance is typically designed for groups that are too small to meet the requirements for standard group coverage. When the policy is life insurance, it's referred to as wholesale insurance. A small accounting firm, in this example, a small accounting firm with 10 employees offered franchise insurance, providing each employee with individual health insurance policies tailored to their needs. Master policy. The master policy is issued to the employer as part of a group plan and includes all the insuring provisions that outline employee benefits. Individual employees who are covered under the group plan receive certificates that summarize their coverage details. Example, Jane's company issued a master policy for their group health insurance plan, and each employee received a certificate of insurance highlighting their specific benefits. Next, non-contributory plan. In a non-contributory plan, the employer pays the total cost of employee benefits. Most states require coverage be provided for all eligible employees. Employees do not contribute to the premium payments. So, usually in a non-contributory plan, all employees must be eligible. Employees do not contribute. So this is like those small life insurance policies people get when they work somewhere that they just automatically have, just from working there. At Linda's workplace, the non-contributory health insurance plan meant she didn't have to pay anything for her medical coverage, as the employer covered all the costs. Okay. Persistency. Persistency in insurance refers to the proportion of policies that continue to be in effect with the insurer after a certain amount of time. So how many policies that are sold remain in force? Persistency is reduced when policies are replaced by the other insurers, canceled by the policyholder, or lapse because of non-payment. Business with stronger persistency rates are typically more secure and generate higher profits than those with weaker persistency. Typically, companies strive to receive 80% persistency rate after 3 years and a 60% rate after 5 years, indicating that 60% of the policies issued 5 years previous should still be active. Example, an insurance company with a high persistency rate demonstrates strong customer retention, indicating policyholders are satisfied with their coverage and service. Okay, next. We are going to be covering some premiums, beneficiaries, benefits, stuff like that. We covered the accelerated benefit rider. We covered that already. Beneficiary, this is the person or entity specified in the life insurance policy to receive proceeds upon the insured's death. So the beneficiary is the one who gets the money when the insured dies. We already covered cash value. Class designation is refers to identifying a group of beneficiaries, such as all my children, instead of listing specific individuals by name. So if you have a beneficiary as a class designation, all my children, that it will be divided equally among all that person's children. That's what class designation is. It's a class of people. It's a group of people. Just remember, I can assign the benefit to my class, my classmates. It'll all be split equally. Common disaster provision. This is important. So the Common Disaster Provision, part of the Uniform Simultaneous Death Act, guarantees that if both the insured and the primary beneficiary die in a short time span, the death benefits go to the contingent beneficiary. The primary beneficiary must survive the insured by a certain period to receive payout. For example, Tom has a life insurance policy with his wife, Emily, as the primary beneficiary, and their daughter, Lily, as the contingent beneficiary. The policy includes a common disaster provision. If Tom and Emily are both involved in a car accident and Emily dies within 30 days of Tom's death, the death benefit will bypass Emily and go directly to Lily. This ensures that the benefit is still distributed even if the primary beneficiary does not survive long enough to claim it. Okay, so they have to live a certain amount. If they're in the same accident, the primary beneficiary has to outlive the primary insured by a certain amount of time before their beneficiaries are still eligible for it. If they die in a certain amount of time, then the contingent beneficiary will receive the benefit. That brings us to contingent beneficiary. The contingent beneficiary will receive the death benefit if the primary beneficiary predeceases the insured. Okay, so if If the primary beneficiary dies before the insured dies, then the contingent beneficiary gets it. Okay. Take some time to learn and read about this, the common disaster provision. That was confusing to me. This kind of explains it pretty simply, though. Earned premium is the part of the premium paid by the policyholder for the insurance coverage they've received so far. Example: if Susan pays an annual premium of $1,200 for her homeowner's insurance policy and 6 months have passed, the insurer has earned half of the premium, or $600, for the coverage provided during that time. The remaining $600 is considered unearned premium until the coverage is provided for the second half of the year. Expense factor. The expense factor, or loading charge, represents the expenses incurred by the insurance company to operate. Okay. Example: when determining the premium for a life insurance policy, the insurer includes the expense factor to cover the costs of operating the company, such as administrative fees, agent commissions, and marketing expenses. So the expense factor is built into the insurance premium. It's part of it, and it's part of the premium that's paid. And it says, hey, this is how much it costs us to operate the company. Okay, excess interest. The excess interest provision in life insurance means that if the insurer earns more than the guaranteed rate, the cash value of a policy will grow at a faster rate. Example: Lisa's whole life insurance policy has a guaranteed cash value growth rate of 3%. However, because the insurer experienced strong investment returns that year, her policy benefits from the excess interest provision, allowing her cash value to grow at 4.5% instead. This means her cash value will accumulate more quickly than initially guaranteed. Fixed amount installment option. Okay. A fixed amount installment option disperses the death benefit in predetermined installment amounts until both the principal and accrued interest are fully paid out. So this is a death benefit option. Sarah's life insurance policy has a fixed amount installment option. After her death, the $200,000 death benefit will be paid to her son Mark in fixed installments of $1,500 per month. These payments will continue until the entire These payments will continue until the entire $200,000 plus any accumulated interest has been exhausted. So, give a little example there. I'll pull out my handy dandy whiteboard. Say we got the $200K right here, okay? This is the $200,000 death benefit, okay? $200K death benefit. Put the little K in there. There we go. Can't forget about the K. Okay, so instead of this just going in one lump sum, it goes in small little installments of $1,500, okay? And at the same time, as the $1,500 increments are being taken out of this, this is earning interest. So interest is accumulating on it, right? So what it'll do, it'll pay out those $1,500 payments until the whole $200,000 is paid up, plus the interest that was generated while that money was just sitting there, having those little chunks taken out of it. Okay? Okay. Fixed level premium. Yeah, we already talked about that. So this involves spreading the total cost of a policy into regular payments. Okay? More frequent payments result in a higher overall premium. So example, Emily purchased a life insurance policy with a fixed or level premium of $1,200 annually. If she wants to make monthly payments, her premiums will be $115 per month, which results in a total annual premium of $1,380. This higher cost reflects the added cost of more frequent payments, okay? Because there's, they have to pay someone to process the payment and all that stuff. Okay. Fixed period or period certain option. A fixed period or period certain option pays out the death benefit in equal installments over a specific number of years. The installment amount is determined by dividing the total benefit by the number of installments. Example, Michael's life insurance policy has a fixed period option. After his death, the $300,000 death benefit will be paid out in equal installments over 10 years. Each year, his beneficiary will receive $30,000 until the entire death benefit plus interest has been paid out. So we had the fixed amount option, which is, hey, $1,500 a month until it runs out, right? And this is the fixed period or period certain option, which pays for a certain amount of time. So a certain, it pay, like however amount it needs to pay in equal installments over a certain period of time. Okay. Next is graded premium. Graded premium is a funding option where premiums start lower and gradually increase annually for a set introductory period. The premium rises to a higher rate than the initial level premium would have been once the introductory period ends and remains unchanged for the life of the policy. So, Jennifer purchases a life insurance policy with a graded premium option. For the first 5 years, she pays a lower premium starting at $50 a month, which increases annually to $80 by the end of year 5. At the introductory period, her premium jumps to, or after the introductory period, her premium jumps to $150 per month and remains fixed at that amount for the rest of her life. So it starts at 50, increases a little bit until it gets to 80, and then after that period, it jumps to 150. Okay. Gross annual premium. The gross premium is the sum of the net premium for insurance coverage plus commissions, operating expenses, miscellaneous costs, and dividends. Example, John purchases a life insurance policy with an annual premium of $1,500. This gross premium includes the net premium required to cover the cost of insurance plus commissions paid to the agent, administrative fees, and other operating expenses. Additionally, if the insurer offers dividends, those are factored into the calculation of the gross premium. So includes how much is there to cover the cost of insurance, but then it also includes what commissions have to be paid to the agents and other administrative and operating expenses too. So say just to cover the insurance, it was $1,100, but then all the other stuff added up to $1,500 total. Interest factor. The interest factor involves calculating the expected earnings from investing the collected insurance premium. So basically in insurance, how it works is like this. We have all the insureds, right? So we're going to do this. A bunch of people who want insurance, okay? Or who have insurance. Okay. Those are a bunch of people paying insurance. Now they're paying their premiums every month into this fund, okay? Well, to the insurance company, not into a fund. So they pay their premiums every month, okay, or every year. Premiums, okay. Premiums. Now, the insurance company takes these premiums and invests it, and then these earn interest, right? So the insurance company tries to make a profit off of the premiums that are paid in. So this calculates the expected earnings from the collected insurance premium. So we're talking about the expense factor here. We're talking about the earnings that are expected interest from the collected premiums. When settling premiums, the insurance company considers the interest factor. For instance, if the insurer expects to earn 3% annually by investing the collected premiums, they can charge lower premiums while still ensuring that they have enough to pay future claims. This anticipated investment return helps reduce the overall cost of the policy for the policyholder. Okay. Next, we have the interest-only option. Okay. Okay. The interest-only option is a death settlement choice where the insurance company retains the death benefit for a specified period and provides the beneficiary with only the interest earned during that time. Okay? So this is where the insurance company retains the death benefit for a certain period and provides the beneficiary with the interest earned. So minimum interest rates guaranteed. The interest must be paid out at least once a year. So this is a death benefit option. Emma's life insurance policy has an interest-only option. After her death, the insurance company holds the $250,000 death benefit and pays the interest earned to her beneficiary, Mark, at a guaranteed rate of 3% annually. Excuse me. Mark receives $7,500 per year in interest payments while the principal remains untouched. I am kind of sick right now, so pardon me. The full 200 dang. The full $250,000 death benefit will be paid to Mark at a later date or when he decides to receive the lump sum. Irrevocable beneficiary. An irrevocable beneficiary is one whose designation cannot be altered by the policyholder without obtaining written permission from the beneficiary. So there's two types of beneficiaries. There's revocable, and then there's irrevocable. Revocable can be changed. Irrevocable cannot be without the policyholder's consent. It's that simple. Joint survivor option. This is a settlement choice that ensures benefits are paid for life to two or more individuals. This choice may have a certain period, and the payment amounts are determined by the beneficiary's ages. Example: John and his wife Mary select the joint and survivor option for their life insurance settlement. This ensures that benefits will be paid as long as either of them is alive. If John passes away first, Mary will continue receiving payments for the rest of her life. The payment amount is determined by their ages at the time of settlement. If they also select a 10-year period certain and both pass away within those 10 years, their beneficiaries will continue receiving the payments for the remainder of that period. So that's an option that they can have to where as long as the primary beneficiary and a secondary beneficiary are still alive. Okay, so that's how it works. It has to do with the beneficiary succession and payouts. Life income option. The life income option provides a death benefit settlement where the beneficiary receives guaranteed income for life. So each installment amount is determined by the life expectancy of the recipient and the total principal. So this is essentially you turn the death benefit into an immediate annuity, into a life income annuity. Example: Sarah selects the life income option for her life insurance policy. After the death, her beneficiary, Jack, will receive monthly installment payments for the rest of his life. The amount of each payment is determined by Jack's life expectancy and the total death benefit. Regardless of how long Jack lives, the payments will continue for his lifetime, ensuring he has a steady income that he cannot outlive. Life settlement. A life settlement involves a policyholder selling or transferring their life insurance policy to a third party for an amount that's less than the policy's expected death benefit. Example: David, at age 70, decides he no longer needs his $500,000 life insurance policy. He enters into a life settlement agreement, selling his policy to a third-party company for $200,000. While the company will receive the full death benefit when David passes away, David receives immediate compensation that is less than the policy's death benefit, but provides him with cash to use during his lifetime. So that's when someone can transfer the rights of their life insurance policy for an amount that's less than the death benefit. So they sell the policy for less than the death benefit to get cash now. Lump sum option. This is the most common one. So this is where the death benefit pays out in full. So it's the entire amount in one payment after deducting any outstanding policy loans and overdue premiums. This is typically the default choice. So that we don't have to talk about the example. Modified premium, we talked about that. Lower premiums for the first few years, and then it jumps to a level premium for the rest of the policy. Morbidity rate reflects the frequency and severity of disabilities anticipated within a specific group of individuals. So it's what's the rate of disability in that group of people. An example, an insurance company offering disability policies evaluates the morbidity rate for a group of 1,000 workers in a high-risk profession. Based on their analysis, they estimate that 10 individuals will experience significant disabilities each year. This projected frequency and severity of disabilities help the insurer determine the appropriate premiums and coverage terms for the group. So this is with disability. They can determine what to rate them depending on the morbidity rate. Like what they'll pay in premiums, they figure out based on the morbidity rate. So how frequent do groups of that type get disabilities? Mortality rate. This is an expression of the number of deaths within a population, adjusted for the size of that population over a given period. An insurance company uses the mortality rate to assess the likelihood of death for a group of 1,000 individuals age 65. As an example, based on historical data, they estimate that 25 individuals from this group will pass away each year. This figure helps the insurer calculate life insurance premiums and determine the risk associated with providing coverage to this population. Next, we have the net payment cost index. Net payment cost index. Okay. The net payment cost index is a formula that calculates the true cost of a policy for the policyholder, allowing consumers to compare the cost of death protection over a period of 10 or 20 years. For example, the net payment cost index is a formula that calculates, Jennifer is comparing two life insurance policies and uses the net payment cost index to determine which offers better value over a 20-year period. One policy has an index of $5.50 per $1,000 of death benefit, while the other has an index of $6.20 per $1,000 of death benefit. Based on this calculation, Jennifer chooses the policy with the lower net payment cost index as it provides more affordable death protection over the long term. Okay, so the lower the net payment cost index, the more bang for your buck. Net single premium. The net premium is the amount calculated by an insurer to maintain policy reserves, considering interest earnings and mortality rate. So it's also called single premium. Example, the insurance company calculates the net or single premium for a life insurance policy by considering the mortality rate and expected interest earnings on the invested premiums. For a 40-year-old policyholder, the net premium for a $100,000 life insurance policy might be $15,000. This calculation helps the insurer make sure they have enough reserves to cover future claims while accounting for mortality risks and investment returns. So this is to make sure that they can, make money and, still pay the claims that they need to. So we're going to talk about a couple of things that have to do with benefits distribution here. Per capita, which is by the head. Per capita, by the head. Per capita means distributing benefits equally among all named beneficiaries. So example, John and his 3 children, Alice, Bob, and Claire, names Alice, Bob, and Claire as beneficiaries of his life insurance policy under the per capita designation. If John passes away, the $300,000 death benefit will be evenly distributed among the 3, with each receiving $100,000. If one of the children predeceases John, the remaining 2 will split the death benefit equally, with each receiving $150,000. Next, you could go per stirps. I think it's called stirps, or stirpies. Per stirps distributes benefits evenly. It could be stirpies, I don't know. Distributes benefits evenly according to the family line. Example, John names his 3 children, again, Alice, Bob, and Claire, as beneficiaries of his life insurance policy under the as per stripe there, but it's per stirps. If Bob passes away before John, Bob's share of the $300,000 death benefit will be evenly distributed among Bob's 2 children. This means that Alice and Claire will receive $100,000. Bob's 2 children will each receive $50,000. Hold on. Alice, Bob, and Claire's beneficiaries, life insurance policy per certain. Passed away before John. Bob should. Alice and Claire will receive $100,000. Oh, okay. So this is saying it's a $300,000 benefit, right? So Alice, Bob, and Claire each receive $100,000. Bob dies, but he has 2 kids, so his $100,000 is split. So his kids automatically become contingent beneficiaries on his benefit amount in the per stirps distribution. Makes sense. Premium mode. Premium mode refers to how often a policyholder chooses to make premium payments. Well, then, annual, monthly, whatever. Primary beneficiary is the first person designated to receive benefits when the insured dies. Policy proceeds, this is what's paid out by the policy. It includes, for death benefits, the policy's face values plus dividends minus any loans. For surrender benefits, it's the cash value minus any surrender charges and loans. And for maturity benefits, which is when they reach age 100, it's the cash value less any loans and interest. Example, when John passes away, the policy proceeds of his life insurance policy amount to $250,000. This includes the face value of the policy plus $5,000 in earned dividends minus the $10,000 outstanding loan amount and accrued interest. His beneficiary, Mary, receives $245,000 after these adjustments. Similarly, if John had surrendered the policy, the proceeds would have included the cash value minus any surrender charges and outstanding loans. Next, we got reserves. Final stretch here, guys. We got 2 pages there, 6 pages there, 4 pages there, and then 4 pages there. So thank you guys for rocking with me here. I know this stuff can be challenging. I know it can be tough, but you got this. I know you're going to do this. You're going to pass your exam. I'm 100% confident that you can do this and that you will do this because you are awesome, okay? Reserves are the funds an insurance company sets aside as required by state laws to ensure they can pay future claims. So state laws require that insurance companies have a certain amount of money set aside in reserves. Example, an insurance company maintains reserves to ensure they can meet future claims. For instance, if the company has issued a large number of life insurance policies, they're required by state law to set aside a portion of the premiums collected in these reserves. The funds are used to pay out claims when policyholders pass away, ensuring the company remains financially stable and able to fulfill its obligations. Revocable beneficiary. A revocable beneficiary is one whom the policy owner can change at any time without needing to inform or obtain consent from the beneficiary. John names his daughter Emily as the revocable beneficiary of his life insurance policy. Since Emily is a revocable beneficiary, John can change. So revocable beneficiary, the owner can change at any time. Settlement options. So we just kind of covered that. These are the death benefits, or these are the the options for policy proceeds to be passed out. It can be interest only, lump sum, fixed amount, fixed period, and life income. And there's also joint and survivor life income. Okay, so those are the different death benefit settlement options. Single premium funding, we've talked about that. They, single premium whole life policy. They make one payment, and then the policy is paid for. Spendthrift clause. The spendthrift clause protects policy proceeds from being claimed by creditors upon the insured's death. So this can, example, John's life insurance policy includes a spendthrift clause. When he passes away, the $500,000 death benefit is protected from his son Mark's creditors. Instead of a lump sum, Mark receives a benefit in fixed monthly installments of $5,000 over 10 years, ensuring the funds are not spent irresponsibly and providing long-term financial security. So saying that creditors cannot go after benefits of a life insurance policy. Surrender cost index. The surrender cost index is a formula that helps calculate the average cost per $1,000 of coverage for a policy that's cashed in for its value, assisting in cost comparisons for policies expected to be surrendered in 10 or 20 years. So that's kind of confusing. See the example. Megan is comparing 2 life insurance policies and uses the surrender cost index to evaluate which would be more cost effective if she plans to surrender the policy in 20 years. One policy has a surrender cost index of $5 per $1,000 of coverage, while the other has an index of $6.50. Based on this calculation, Megan chooses the first policy because it has a lower average cost per $1,000 of coverage if she decides to surrender it for the cash value in the future. Okay? Tertiary beneficiary. The tertiary beneficiary is next in line to receive the death benefit proceeds if both the primary and secondary or contingent beneficiaries are unable to. So it goes primary, contingent, and then secondary. Primary, contingent, secondary. PCT, PCT, PCT. There's a pact. Call it a pact. Underwriting department. We covered this already. That's the department that reviews, approves, or declines insurance applications. Unearned premium is the amount of premium that's been paid for insurance coverage not yet provided. Example, Sarah pays an annual premium of $1,200 for her homeowner's insurance policy, but after 3 months, she decides to cancel the policy. Since the company has only provided coverage for 3 months, and it's $100 a month of cost, she already paid $1,200, the remaining 9 months of the premium, $900, is considered unearned premium and will be refunded to Sarah. Okay. Uniform Simultaneous Death Act. We talked about this, but this dictates that if the insured and the primary beneficiary die simultaneously or nearly so in an accident, without it being clear who died first, it's assumed the primary beneficiary died first. That way the death benefit will go to the contingent beneficiaries. Example, John and his wife Emily are both involved in a car accident and pass away around the same time. Since it's unclear who died first, the Uniform Simultaneous Death Act assumes that Emily, the primary beneficiary, died before John. As a result, the death benefit from John's life insurance policy is paid to their children who are named as the contingent beneficiaries. Viatical settlement. A viatical settlement is when an individual with a terminal illness sells their life insurance policy to a third party for a portion of the death benefit. Okay, so it's when you're going to die and you sell your policy for money. Example, Mark, who's been diagnosed with a terminal illness, decides to enter into a viatical settlement. He sells his $500,000 life insurance policy to a third-party company in exchange for $300,000. The company will receive the full $500,000 death benefit when Mark passes away, but Mark gets immediate access to funds to help cover medical expenses and improve his quality of life during his remaining time. Okay, now in that, the viatical or the viatee is the new third-party owner. So the new third-party owner of the policy is referred to as the viatee or the viatical, and the viator is the original owner of the life insurance policy. So the viator is the original owner of the policy. So in the viatical settlement, you have the viator, who's the original owner, and then the viatical or the viatee, who is the new owner of that policy. Okay, so next we're going to be talking about the uses of life insurance. The uses of life insurance. So let me get right into this here. First one we're going to talk about is actually, first off, if you find value, please subscribe to the channel. Check out my other videos at least. Even if you don't subscribe, just check out the other channels, other videos. I understand you may not watch this after you get your license, but I do have another channel that focuses on sales. It's just youtube.com/@finalexpense. I can help you guys learn how to sell insurance. If you feel, I can also give you a free study guide too. Just reach out in the description of the video. And then also, if you want to work with me selling life insurance, I'd be more than happy to give you an interview, see if you'd be a good fit, and if we'd be a good fit for you. I think we have the best system in the country for new agents to start, but that's just me. So cross-purchase plans. Cross-purchase plans are agreements where surviving business owners commit to buying the deceased owner's share of the business. This is typically funded through life insurance policies that each owner holds on the lives of the other owner. So, example, in a small law firm, each partner has a life insurance policy on the others. If one partner, if one partner passes away, the surviving partners use the insurance payout to buy the deceased partner's share of the business. So we're going to look here on my thing here, cross-purchase plan. I'm going to draw it. So we're going to go here. We're going to do person one. And actually, we'll make him smaller. So I'll do one here. And then we'll do one here. And then one here. Okay? So these are three business owners. Okay? Now, this owner would get life insurance on this one and this one. Okay? This owner will get insurance on this one and this one. Okay? And then this owner will get insurance on this one and this one. Okay? So that way, if this one dies, then these two can purchase his share of the business. Okay? So it says each partner has a life insurance policy on the others. If one partner passes away, the surviving partner use the insurance payout to buy the deceased partner's share of the business. So if this guy right here dies, then his partners get a life insurance benefit so that they can buy his share of the business. So they own the policy. So this one and this one will own the policy on him, and he's the insured and they're the beneficiary. Okay? All right. Entity plans. Entity plans are agreements where the business itself is responsible for purchasing a deceased owner's interest, thereby increasing the ownership stakes of the surviving owners. Example, in a corporation with 4 owners, the business holds life insurance policies on each owner. When one owner dies, the business uses the insurance proceeds to buy back the deceased owner's share and redistribute it among the surviving owners. So in the entity plan, we're going to do this to be a little different. So an entity plan, say we have the 3 people again. Oh, that guy's extra tall. And then here. Okay. In the entity plan, we have the business. Okay. The business has insurance on all 3. That way, say this one dies. Okay. The money goes back in the business to buy back this person's portion, and then it's redistributed amongst the owners of the business. So in this case, the business owns entities or owns insurance on the owners. In this case, the partners own insurance on each other. Okay? So it's a little different. Human life value approach. The human life value approach calculates an individual's economic value based on the projected future earnings that would support their family. Example, to determine how much life insurance John needs, the human life value approach considers his current income, the number of years he plans to work, and the portion of his earnings that supports his family, estimating the total economic loss his family would face if he were to die. Okay, so essentially, we'll take a look here at the human life value approach. Okay, HLV, human life value. Okay, so we're gonna add a little text box. Okay. So if John makes $100,000 a year, okay. Now, if John dies, he wants his income replaced to his family for 20 years. His human life value to his family financially, if say that's his only income, is going to be $100,000 times 20 years times, whatever, if in the inflation, right? So assuming he's going to get raises and stuff like that. So wouldn't it be just straight 2 million? Because that's what it is. I mean, that's what 100,000 times 20 is. It would be 2 million plus interest, right? Or plus take into account that he's going to get a raise every year. So, and then, maybe some of that money would be invested, he'd return on it or something. So it would be more than 2 million, but basics there, 2 million is what he's worth to his family over the next 20 years. Probably be about 2.5, 3, with interest and inflation and him getting raises and stuff like that. But that's basically what human life value is. Human needs approach. The human needs approach evaluates the insurance coverage required by assessing the financial needs and objectives of a family or business if the insured died, became disabled, or retired. Example, using the human needs approach, an insurance advisor determines the amount of coverage needed for Maria by analyzing her family's living expenses, mortgage, children's education costs, and other financial obligations, ensuring her family's financial stability if she were to pass away. So, essentially, the human needs approach views the needs that this woman's family would have if she passes away. So, based on their expenses, their mortgage, education costs, and other things, how much money would they need if Maria passed? Okay, so it's a little different. So human needs, this is just based on the needs, right? So like human life value may go towards above and beyond like needs, right? Human needs is based on, hey, just what does my family need from me if I pass, okay? Key person insurance provides financial protection. Next one, key person insurance. This provides financial protection to a business against the loss resulting from the death or disability of a crucial member, usually someone with essential managerial or technical expertise. Example, when the CEO of a tech startup known for his unique vision and leadership unexpectedly passed away, the company used the key person insurance proceeds to stabilize operations and find a suitable replacement. So, key person insurance covers not only the revenue that the business would lose if that person died, but it also covers the cost of training them. Okay. Needs-based selling. Needs-based selling refers to the ethical obligation of insurance producers to recommend products that meet the specific needs of the client rather than prioritizing the producer's financial gain. A needs-based violation example is when a prospect is sold insurance with the highest premium rather than receiving the appropriate coverage for their situation. Example, an insurance agent practices needs-based selling carefully by assessing a client's financial situation and recommending a life insurance policy that provides adequate coverage without unnecessary features or costs. Okay, so needs-based selling refers to an insurance producer recommending products that fit the client's needs, not ones that necessarily make the insurance producer the most money. Split dollar plans. Split dollar plans are life insurance arrangements between two parties. Life insurance is taken out on one individual who designates a beneficiary to receive the net death benefit, which is the death benefit minus the cash value. The other party is entitled to the cash value. Both parties typically contribute to the premium payments. Example, in a split dollar plan, an executive and their company agree on a life insurance policy. The executive's family is the beneficiary of the death benefit, while the company recovers the cash value of the policy upon the executive's death, and both share the premium costs. Okay. So split dollar plan, the executive and the company agree on a life insurance policy. The executive's family receives the death benefit, while the company recovers the cash value upon the executive's death. Okay. Next, we are going through annuities. Okay, annuities. All right. So a 403B plan. 403B plan is a retirement savings plan available to some employees of public schools and tax-exempt organizations, as well as certain ministers. Okay. So Lisa, a public school, hold on. Lisa, a teacher at a public school, contributes to a 403b plan as part of her retirement savings. Each month, a portion of her salary is invested in the plan, allowing her to accumulate tax-deferred savings over time. When she retires, Lisa can withdraw from the plan to supplement her pension and Social Security income. Okay. So a 403, it's a retirement savings plan. It's a tax-sheltered annuity, a TSA, tax-sheltered annuity. It's available to public school employees, tax-exempt organizations like charities, and certain ministers. So Lisa contributes to her plan for her retirement savings. Every month, a portion of her salary is invested in the plan before tax. Then when she retires, she can withdraw from the plan to supplement her pension and Social Security. So it's like a little annuity. 1035 contract exchange. 1035 contract exchange is a provision of the Internal Revenue Code applying to annuities. It allows for the exchange of an annuity for another annuity without recognizing a gain for tax purposes. This also applies to exchanging a life insurance policy or endowment contract for an annuity. An annuity cannot be converted into a life insurance policy. This tax code permits policyholders to transfer funds from an existing life insurance policy, endowment, or annuity into a new policy without facing tax consequences. Example, Mark owns a life insurance policy but decides he would benefit more from an annuity as he nears retirement. Using the 1035 contract exchange provision, he transfers the cash value of his life insurance policy into a new annuity without triggering any taxable gains. This allows him to defer taxes and transition his funds smoothly into a product better suited to his retirement goals. So we're going to do a little illustration here so you can see. We got, oh, I'm way over there. Okay. We have, let's say we have a life insurance policy, okay, LI. And inside the life insurance policy, there's cash value, okay? Cash value. Say this cash value is $400,000, okay? You can take this $400,000 and put it into an annuity through a 1035 exchange. Okay? So a 1035 exchange into an annuity. Okay? And this is no tax consequence at all. So this goes into this, and then you start receiving payments. You can start receiving payments from the annuity. All right? Now, the payments from the annuity might be taxed as ordinary income. It depends how it's structured. But the 400K can be transferred into a new annuity. You know, so this can also be used to buy a new life insurance policy. That's usually not recommended, but sometimes it can. Okay, so you can transfer one thing to another, the value one thing to another without tax consequences. Okay. Accumulation period. So this has to do with an annuity. Accumulation period is the phase during which, an annuitant's premium payments are credited as accumulation units. The accumulation phase can extend beyond when premium payments stop, but before the payout phase begins. These accumulation units are converted into annuity units for payout at the end of the accumulation period. During the accumulation period of his deferred annuity, James makes regular premium payments. These payments are credited as accumulation units which grow over time through investments. Even after James stops making payments, this accumulation period continues until he decides to start receiving payments. When the accumulation period ends, his accumulation units are converted into annuity units, determining the size of his future payouts. Okay? So, one second here. There might be an error here. So are you units? Okay, never mind. Accumulation units represents the value of an annuitant's contribution to their annuity minus expenses. The worth of each accumulation unit is credited to the individual's account and fluctuates based on the performance of the underlying stock investment in a variable annuity. Okay, so these are on variable annuities. So the accumulation units are only applicable to variable annuities. Okay, I believe that's the case. I like know it is, but it's only applicable to variable annuities. Yeah, they're primarily associated with variable annuities. Okay, so where you see here, I'm going to edit this. Premium payments. Increase the value of the annuity in a variable annuity. There are accumulation units. Increase. In a variable annuity, here we go. Accumulation units increase. Okay, so accumulation units are specific to variable annuities because of the investment component. Fixed annuities do not involve accumulation units as they have guaranteed interest rates or fixed payments. In the accumulation units, variable annuity, are converted into annuity payouts at the end of the accumulation period. Okay? In a fixed annuity, the value is distributed. Total accumulated value is distributed. Okay. So we're just going to lower this here so it all fits. Okay. So, example, during the accumulation period of his deferred variable annuity, James makes regular premium payments. These payments are credited as accumulation units which grow over time through investments. Even after James stops making payments, the accumulation period continues until he decides to start receiving payouts. When the accumulation period ends, his accumulation units are converted into annuity units, determining the size of his future payouts. Okay, so in a fixed annuity, guys, sorry, this is the only issue I've had in all these, only correction. The fixed annuity, the value just increases as they pay in the money, and then whatever is there accumulated at the end, the whole value gets distributed based on whatever payout option they select. Accumulation units represent the value of an annuitant's contributions to their annuity minus expenses. Expenses like it costs money to invest in stocks and stuff like that, or the mutual funds. The worth of each accumulation unit is credited to the individual's account and fluctuates based on the performance of the underlying stock. So every time they pay in, there's an accumulation unit. Then the value of that unit is credited to the underlying stock investments. Example, Sarah has a variable annuity and makes monthly contributions during the accumulation phase. Each payout buys accumulation units, which are credited to her account. The value of these units fluctuates with the performance of the underlying investments in her annuity portfolio. As the stock market performs well, the value of Sarah's accumulation units increases, enhancing the overall value of her annuity. So I'm going to show you here, basically, the fixed annuity first. So we fixed, okay, fixed. So you pay in the money, or pay in during the accumulation phase. Okay. Accumulation phase. Money's paid in. Okay. And then the annuity phase, the payout phase, the money's paid out. So in a fixed, the money's paid in. This can be a lump sum at one time, or this can be multiple payments paid over time, which would result in the deferred annuity. Okay, so a fixed fixed versus variable. Well, I'm not going to put that there, but a variable annuity, the underlying investments is in mutual funds and bonds and stocks. A fixed annuity, the underlying investment is in the company's general account. Okay? So it's in the company's general account. All right. In a fixed annuity, the person pays in and then they choose the annuity payout options, which we'll cover in a minute here. But in a variable annuity, as it's paid in, the value doesn't increase. They purchase accumulation units whenever they pay into it. Essentially, that's what happens. So, annuitant. An annuitant is the person who receives payments from an annuity or whose life expectancy determines the duration of the annuity payments. Example, Sarah is the annuitant of her retirement annuity, meaning she will receive monthly payments for as long as she lives. Annuity units. Annuity units are the conversion of accumulation units into annuity units used for calculating payouts in a variable annuity. Once the initial payout calculation is made, the number of annuity units remains constant for the annuitant. So, essentially, annuity units, accumulation, so during the accumulation phase in a variable annuity, accumulation units are purchased. In the annuity period, in the annuitization phase, the accumulation units are converted to annuity units, and then their value is based on the underlying investment value. Example, after years of contributing to his variable annuity, Tom decides to begin receiving payments. At this point, his accumulation units are converted into annuity units based on the current value of the underlying investments. While the value of each annuity unit might fluctuate, the total number of annuity units Tom holds remains the same throughout the payout period, determining the amount he receives in each payout. Okay, so the total number of units remains the same, but the value of each annuity unit might fluctuate based on the underlying investment performance. So now there's also annuity payout options. So there's cash refund option. The cash refund option ensures that if the annuitant dies before receiving payments equal to the purchase price of the annuity, the difference is paid out in a lump sum to the designated beneficiaries. So if the annuitant dies before receiving payments equal to the purchase price of the annuity, the difference is paid out in a lump sum to the beneficiaries. Example, John purchases an annuity with a cash refund option. He receives monthly payments from the annuity, but passes away before the total payments equal the amount he initially paid into the annuity. Under the cash refund option, the remaining balance is paid in a lump sum to his daughter, the designated beneficiary. Okay, so he receives payments but passes away. So say he has a cash refund option, and there's a $100,000 annuity. So we'll do it right here. So cash refund option, CR, cash refund. Okay, say John has a cash refund, and there's the amount that he pays, the value of the annuity is $100,000. Okay, if he takes payments and they end up paying out $80K to him, and he dies, his daughter gets the $20K. Okay? His daughter gets the $20K difference. Okay. It would just be in one chunk, in a lump sum to his daughter. Deferred annuity. A deferred annuity is an annuity that delays payments until after a specified period or the annuitant reaches a certain age. It can be purchased with a single premium through flexible premium payments. Single premium or through flexible premium payments. They generally start providing income payments no sooner than 1 year after the purchase date. Example, Emily purchases a deferred annuity at age 50, making regular contributions over several years. The annuity is designed to start paying out when she turns 65, providing her with a steady income during retirement. Since the payouts are delayed until that time, her contributions have time to grow through investments before receiving payments. So, we'll do deferred annuity. Deferred. So we'll take person, 50 years old. 50 years old, okay? They get a deferred annuity. They make payments until 65 years old. And then they want money to start coming back to them. Okay? So a deferred annuity, it can be either a single premium where that 50-year-old puts a bunch of money in at one shot and then it grows until 65, or it can be multiple payments over time until age 65. Now, whatever's accumulated at that time will then pay out over time in an income stream to this person once they reach retirement age. Yay, retired. Okay. Equity indexed annuities. Equity indexed annuities are a form of fixed deferred annuity. Okay, so it's a deferred annuity, and fixed, meaning the interest is fixed, it's not variable. It ensures, an equity index annuity ensures a minimum interest rate with the opportunity to earn extra interest linked to the performance of a market index. Example, Michael invests in an equity index annuity which guarantees him a minimum interest rate on his contributions. Additionally, if the stock market index performs well, his annuity earns extra interest tied to the index's growth. This allows Michael to benefit from potential market gains while still having the security of a guaranteed return if the market underperforms. So it allows him to get a little extra gain, but not all the gain if the market performs up to a certain amount, and it gives him a minimum floor. So this is the way that equity index products work. This is equity. This is index life, index universal life, and index annuities. So we'll take, say the maximum it can earn is 8%, and then the minimum it can earn is 2%, okay? Like this. So this is the max, and this is the minimum, okay? 8% and 2%. Anywhere in here, it can earn from there. If the market performs higher, so say the market performs at 12%, okay? The company, the insurance company keeps the excess, 4%, and the annuitant is credited with an 8% return on their account, okay? If it earns less than 2% or less, then the minimum it can earn is 2. So that's the floor. It could possibly, it can't go lower than that in this example. So it can earn, the thing is it can earn in between here. So it has a guaranteed minimum, but it also has the ability to participate in some upside gain. Anything over this, the company is going to take. Okay. Exclusion ratio is a calculation used to determine the portion of annuity income that is not subject to federal income tax. Okay. The exclusion ratio is a calculation used to determine the portion of annuity income that is not subject to federal income tax. It's found by dividing the total amount invested in the annuity by the total expected payouts. Okay? Total amount invested by the total expected payouts. Okay. Example. Susan invested $100,000 in an annuity and expects to receive $200,000 in total payouts over her lifetime. Using the exclusion ratio, she divides her investment, $100,000, by the total expected payouts, $200,000, resulting in an exclusion ratio of 50%. This means that 50% of each payment she receives is not subject to federal income tax, while the remaining 50% is taxable. So what this means is that if you have an annuity and you're receiving payments from it, whatever you've paid in is not taxable once it starts paying out, okay? So if someone's been paying into an annuity and then they start receiving payments from it, it uses a ratio to figure out what percentage of that payment is taxable. So it takes a piece out in taxes, and then some of it's not taxable. So they take how much they paid in, they divide how much they paid in by the amount of the annuity, and then that's the exclusion ratio. Fixed annuity. Fixed annuities provide a consistent rate of return, with the insurer declaring the interest rate in advance, ensuring it will not drop below a specified minimum. The insurer takes the investment rate. So before we were talking about variable annuity, this is fixed annuity, where money's paid in for a certain amount of time, then it's distributed. So in this example above, person's paying in $100,000, it turns into two, and then over the lifetime of the annuity, she's going to get back $200,000. Okay, so Lisa purchased a fixed annuity with a guaranteed minimum interest rate of 2%. For the first year, the insurance company declares an interest rate of 3%, so Lisa will earn 3% on her contributions that year. However, even if the declared interest rate drops in future years, it will never go below the 2% guaranteed minimum stated in her contract. Immediate annuities. So this has to do with there's immediate and then deferred. Immediate annuities begin paying out benefits one payment cycle after the purchase date. They are bought with a single lump sum and begin dispersing income typically within a month. So, example, John invests a lump sum of $100,000 into an immediate annuity upon his retirement. The annuity starts paying him monthly income 1 month after the purchase, providing him with a steady stream of payments for the rest of his life. So immediate annuity, someone retires, they take their retirement money or a chunk of it, they put it in an annuity. That way they can just get paid income for the rest of their life. Joint life and survivor option on an annuity. The joint and survivor option ensures that annuity payments continue to be made to two individuals. If one passes away, the surviving person continues to receive the same income payments for life. Once the surviving annuitant passes away, no additional payments are made to any beneficiaries. There are variations, though. Under the full survivor option, the same benefit amount is paid to the surviving individual. Under the two-thirds survivor option, the surviving individual gets 2/3 of the initial benefit amount, while the one-half survivor option provides half of the original benefit. Example, Mary and John chose the joint life and survivor option for their annuity. After John passed away, Mary continued to receive the same monthly payments for the rest of her life. Next, life with period certain annuity, life income with term certain option. The life with period certain annuity, also known as the life income with term certain option, provides income to the annuitant for life while guaranteeing payments for a specific minimum period. If the annuitant passes away within the designated period, the beneficiary will receive the remaining benefit payments for the rest of that time frame. So Susan purchases a life with period certain annuity with a 10-year term. She receives monthly payments for life. If Susan passes away after 6 years, her designated beneficiary will continue to receive the same monthly payments for the remaining 4 years, ensuring that the minimum 10-year payout is fulfilled. If Susan lives beyond the 10 years, payments will continue for her lifetime, but no further payments will be made to anyone after death. So that's saying, hey, a life with period certain, or life income with term certain option, but this life with period certain means I'm getting income for the rest of my life, but I'm guaranteed that if I die within a certain time period, that payments will continue for a specified time period after that. Like, I'm guaranteed that payments to either myself or my beneficiary will be for a certain amount of time. Because if it's just a straight life annuity, then once someone dies, the income payments stop. Market value adjustment. A market value adjustment annuity, a market value adjustment can be included in a deferred annuity, offering a guarantee of fixed interest rate along with an adjustment factor that can alter, increase, or decrease the actual credited interest rates based on market conditions. Unlike equity indexed annuity, an MVA annuity's interest rate remains guaranteed fixed. So a market value adjustment annuity's interest rate remains guaranteed fixed if the contract is held for the specified period. The market value adjustment feature is only relevant if the contract is surrendered before the end of the specified period. Otherwise, the annuity operates like a standard fixed annuity. Example, Jack buys a deferred annuity with a 7-year term and a market value adjustment. If he holds it for the full term, he receives a fixed interest rate. However, if he surrenders the annuity early, the market value adjustment applies. If market rates have risen, his payout decreases. If they have fallen, his payout increases. If held for the full term, no adjustment occurs. Okay. Period certain annuity. A period certain annuity guarantees income payments for a specified minimum period, such as 10 or 20 years, regardless of whether the annuitant lives or dies during that time. Okay. Example, Karen chooses a period certain annuity with a 10-year payout option. Once she begins receiving payments, she receives monthly payments for 10 years. And if she passes away before the period ends, her beneficiary will continue receiving the payments for the remainder of the 10-year term. After 10 years, payments stop regardless of whether Karen or her beneficiary is still living. So a period certain says, hey, I'm going to get the money in that certain amount of time. Okay. So period certain says that we're going to disperse this annuity within this certain period of time. Okay. Or for a minimum within that period of time. Okay. Periodic payment annuity. Flexible premium. So a periodic payment annuity, also known as a flexible premium annuity, allows the owner to make multiple premium payments to build up the principal. After the initial payment, subsequent payments can be made flexibly in terms of both timing and amount. Example, Maria purchases a periodic payment annuity and makes an initial deposit to start building her principal. Over the years, she contributes principal is the amount in the annuity. Over the years, she contributes additional amounts whenever she has extra funds with no set schedule or required minimums. As her contributions grow, so does the value of her annuity, which will eventually provide her with a steady income during retirement. Okay? So a periodic annuity allows you to make an initial deposit and then start paying amounts over time whenever you're able to, with no schedule or required minimums. Principal. The principal represents the amount of money invested in an annuity through one or more premium payments. So, for example, Lisa contributed $50,000 as the principal amount into her annuity, which will grow over time and eventually provide her with income during retirement. Okay. Single premium annuity. A single premium annuity involves making a one-time payment at the beginning of the contract. It can be structured as either a deferred or immediate annuity. Example, Mark purchased a single premium annuity by investing $100,000, ensuring he would start receiving monthly payments immediately. So a single premium annuity, you pay once. If it's an immediate annuity, you get money right away. If it's deferred, the amount that you invested increases over time, then you start receiving payments. Okay. Straight life annuity. A straight life annuity is an annuity option that provides guaranteed income for life for the lifetime of the annuitant, with payments ceasing upon the annuitant's death. So John selected a straight life annuity in this example. This guarantees him monthly payments for as long as he lives, but no benefits paid to his beneficiaries after death. So it's just for the lifetime of the individual. Variable annuities. In variable annuities, the investment risk is transferred from the insurer to the contract owner. Variable annuities are comparable to traditional fixed annuities in that they offer regular retirement payments to the annuitants, generally for the rest of their lives. Unlike fixed annuities, the payment from the variable annuities are not guaranteed and can fluctuate based on the performance of the investments, typically stocks. These annuities invest the deferred payments into the insurance company's separate accounts, which is involved in stocks and mutual funds, rather than general accounts used for fixed annuities. Because the value of these investments is not guaranteed, a sales representative, an agent, must be registered with the Financial Industry Regulation Authority, FINRA, and hold a state insurance license to sell variable annuities. Example, Jessica purchased a variable annuity, which allows her to invest in various stock portfolios. Her retirement income will vary based on how well these investments perform, rather than having a fixed payout. I'm going to clarify deferred and variable annuities here real quick. just in case you're not there. So we have fixed and variable. So we have fixed. Okay, fixed. You put in 100K of your money. Say with interest and everything, it became $200,000 by the time you're ready to annuitize it. And then that will disperse to you over time, and you may end up getting, 300K from it or whatever. Okay. So when the annuitization period starts, say it's equal to $200,000 because it was a deferred annuity, and it grew, and then it's paid out over time, and all the payments end up equaling like $300,000. So that's just an example of fixed. For variable, okay. For variable annuity, when you're paying in, you're purchasing accumulation units, okay? So accumulation units are purchased. So accumulation units. So it's not just like a straight $100,000. It's a certain amount of units. And then once you retire, these are converted to or once you want to start payouts, these are converted to annuity units, okay? These are converted to annuity units. And then the value of the annuity units is based on the value of the underlying investment. So the investment, whatever it's invested in, will determine the value of the annuity units. Wow, I'm like losing my voice here. This is taking me several hours and definitely under the radar a little bit. But we only got 2 more to do. So we shall make it. Thank you all for rocking with me here. Hope this is helping you. Social Security Act of 1935. So the Social Security Act, this was established to promote the general welfare of citizens aged 65 and older. Enacted by the Senate and House of Representatives, the act aimed to help individual states provide financial assistance for various groups, including the elderly, the blind, dependent, and disabled children, and for maternal and child welfare, public health, and unemployment compensation. So this was aimed to help people who were older, blind, dependent, or disabled children, for maternal, meaning moms taking care of their kids. Maternal and child welfare means mom taking care of their kids. Public health and unemployment compensation. So this is because during the Great Depression, people like really, really, really had it rough. And they were like, hey, we need to be able to provide some money to people so they're not starving to death. And like, even if someone's homeless, maybe they can have like a basic like eat off it, right? It wasn't intended for people to live off of. A lot of people live off it now, but it was intended to be an additional supplement to other forms of income people would have when they retire. So key purposes: creation of the Social Security Board. Okay, they also had to raise revenue for it, and it offered basic financial protection to working Americans against the challenges of death, disability, and aging. Right? Because imagine if someone didn't have a pension or something, and they just retired with some money. They needed something to help with that. Amendments to the Act. In 1939, the survivors' benefits and benefits for retirees, spouse, and children were added. So survivors' benefits, which is if someone dies, then benefits can continue, and benefits for the retiree's spouse and children. In 1956, disability benefits were introduced. Social Security operates as an entitlement program where individuals contribute during their working years in exchange for benefits later, rather than a welfare program. So an entitlement program is people are supposed to contribute into it, and then they get the money later, rather than a welfare program, which is when people just get money for free. Example: John has contributed to Social Security throughout his career. At age 65, he begins receiving retirement benefits. If he passes away, his wife and children can claim survivor's benefits. Had John become disabled before retirement, he would have been eligible for disability benefits. This illustrates pay now, receive later system of Social Security, which provides financial protection against aging, death, and disability. So what this is essentially like, hey, contribute a little bit while you're able to, and you can get more later. Blackout period. The blackout period is the time following the death of the main income earner in a family, during which the surviving spouse is not eligible for Social Security benefits. Example: after John's death, his wife Sarah received Social Security benefits to support their young children. However, once the children turn 18, Sarah enters a blackout period, during which she no longer qualifies for benefits. She will not receive Social Security benefits again until she reaches retirement age. Credits. Credits determine whether an individual is classified as fully insured or currently insured under Social Security. Being fully insured qualifies the person's family for survivorship benefits upon their death. Put simply, the family is entitled to receive survivor benefits when someone is fully insured. Key points: a person can earn a maximum of 4 credits per year. To meet the 40-quarter rule, which grants fully insured status, an individual must have worked and paid FICA taxes for at least 10 years. Okay. Example: over the course of his career, Tom earned enough credits to pay through FICA taxes to become fully insured, FICA taxes, to become fully insured under Social Security. By working for at least 10 years and earning 4 credits each year, he met the 40-quarter rule. As a result, if Tom passes away, his family becomes eligible to receive Social Security survivorship benefits due to his fully insured status. Currently insured. Currently insured status under Social Security provides limited eligibility, offering only death benefits. Example: Jake has worked several years, but has not yet earned enough credits to be fully insured. However, because he has earned at least 6 credits in the last 3 years, he is currently insured. If Jake were to pass away, his family would be eligible to receive Social Security death benefits, though they wouldn't qualify for other benefits like survivors' retirement benefits. Disability benefit qualifications. Social Security determines eligibility for disability benefits using both medical and non-medical criteria. To qualify for Social Security disability insurance, SSDI, which is based on work credits, or supplemental security income, which is for low-income individuals, one must first prove they are medically disabled. Mark qualifies for Social Security disability insurance after proving his disability and having enough work credits. Meanwhile, Lisa, with no work history but low income, applies for supplemental security income and must also prove her disability to receive benefits. So you need disabilities to receive both. FICA taxes, Federal Insurance Contributions Act. Okay? FICA taxes are payroll taxes used to fund Social Security program. Individuals who do not contribute through their payroll are not eligible for Social Security benefits. Example: John's paycheck includes deductions for FICA taxes, which contribute to his future Social Security benefits. Next, fully insured. Fully insured status grants complete eligibility for all Social Security benefits, including retirement, disability, Medicare, and death benefits. So if you're fully insured, you get all the benefits, like retirement benefits, disability benefits, Medicare, and death benefits. To achieve this status, a person must have contributed FICA taxes for at least 40 quarters, equivalent to 10 years of employment. Example: after working for over a decade and paying FICA taxes, Lisa became fully insured, making her eligible for the full range of Social Security benefits. Okay, fully and permanently insured. An individual is considered fully and permanently insured if they have paid FICA contributions for at least 40 quarters, and those quarters do not have to be consecutive. Example: after working for more than 10 years and earning 40 quarters of FICA contributions, Maria is considered fully and permanently insured. This status ensures that she qualifies for Social Security benefits, such as retirement and survivorship benefits, regardless of whether her 40 quarters were earned consecutively. OASDI, Old Age Survivor and Disability Insurance. Old Age Survivor and Disability Insurance, more commonly known as Social Security, is funded through a tax on earned income withheld by employers. The OASDI deduction on a paycheck indicates the amount withheld for this purpose. I'm not going to go in the example. Primary insurance amount, PIA. The PIA is the amount a person is entitled to receive as a retirement benefit if they begin collecting at their normal retirement age. So that's the primary insurance amount. That's how much they can receive as a benefit if they collect at the normal age. This amount is calculated before rounding down to the nearest whole dollar. At normal retirement age, the benefit is not reduced as it is with early retirement or increased as is the case with delayed retirement. Example, when James reaches his normal retirement age, his primary insurance amount is calculated to be $1,850. Since he is retiring at full retirement age, he will receive the full primary insurance amount with any reductions or increases. If James had chosen early retirement, his benefit would have been reduced, or if he had delayed retirement, the amount would have been increased. Quarter of coverage. A quarter of coverage is a fundamental unit used to determine a worker's insured status under the Social Security program. Example, each year, Sarah earns enough income to qualify for 4 quarters of coverage under Social Security. These quarters are used to determine her insured status and eligibility for benefits, such as retirement and disability, once she accumulates the necessary total over time. She needs 40 quarters total. Retirement benefits. Social Security retirement benefits are available to fully insured covered workers upon retirement and are paid monthly. Workers retiring at the normal retirement age receive 100% of their primary insurance amount, PIA. Typically, right now, it's 65, but it might change. Early retirement age at 62 results in a maximum benefit of 80% of the primary insurance amount, with this reduction persisting through retirement. Retirement benefits offer a monthly income to retired workers who are covered, along with their spouses and qualifying dependents. So say the primary insurance amount is, whatever amount a month, 80% of that, if they retire at 62, so it'll be 80% of that primary insurance amount. Example, Jane decided to retire at age 62, so she receives 80% of her primary insurance amount as her monthly Social Security retirement benefit. Next, taxation of Social Security benefits. Social Security benefits are subject to federal income tax if the recipient's annual income exceeds certain thresholds. So your benefits are taxed if your income exceeds a certain amount. For individual filers, benefits are taxable if their annual income is over $25,000. For joint filers, they're taxable if the combined income exceeds $32,000. So the benefit's not taxed if someone makes $25,000 or less. Example, when John files his taxes as an individual, his total income, including Social Security benefits and other sources, is $28,000. Since this exceeds the $25,000 threshold, a portion of his Social Security benefits will be subject to federal income tax. Similarly, if John and his wife file jointly and their combined income is $35,000, they will owe taxes on a portion of their Social Security benefits since their income exceeds the $32,000 limit for joint filers. So that includes all income sources. Can't make more than $25,000 individual or $32,000 jointly. Okay. Next, we are covering retirement plans. 401k plans. A 401k plan is an employer-sponsored retirement savings plan that allows employees to save and invest a portion of their earnings before taxes are deducted. Taxes are deferred until the money is withdrawn. Mike contributes a portion of his salary to his 401k plan, reducing his taxable income for the year and saving for his retirement. So, what happens in a 401k? You, as the employee, say someone makes $100,000, they can contribute a piece of this, not pay tax on the money right now. Okay, their employer, the company, it's a bad illustration of a building, but the employer can also match up to a certain amount. So that money grows tax deferred, and they don't have to pay tax on the money they're paying in. So that'll lower the taxable income this year. So for example, say they put in $5,000, okay? They're not going to pay tax on $100,000 this year. They're just going to pay tax on the $95,000 amount, okay? So because tax on $95,000 is lower than $100,000, right? So that can help reduce how much they have to pay in taxes too, and allows them to save for retirement later on. Okay. 403B, we covered those. Those are tax deferred annuities. A tax sheltered annuity. Defined benefit plans. These are pension plans because the benefit is defined, right? So this is saying you're going to get a certain amount. Your benefit is a certain amount. So it has a defined amount, a specific amount that they'll get every month. As compared to defined contribution plans, which are a lot more popular now. That's pretty much what people have now, where they have to pay in, and there's a defined limit to how much they can pay in. Defined pension plans, defined benefit plans. These are pension plans where the benefits are calculated based on a specific formula. Example, Laura works for a company that offers a defined benefit plan. Upon retirement, her monthly pension is calculated using a formula that considers her years of service, salary, and age. This guarantees her a set income for life, regardless of how the investments perform, providing her with predictable financial security in retirement. Defined benefit plans are a lot less popular now because when these things came out, people would retire at 65 and live until 75. Now people live until like 90, 95. So imagine someone works at a company for 30, 40 years, they retire at 65, and then they're alive for another 30 years. So that company, like before, they used to only have to pay people for 5 or 10 years from they retired before they died. Now they're paying them for 30 or 40 years. So they just get, a lot of those plans don't exist anymore. Pensions aren't as popular. Defined contribution plans are. So these are plans that are tax advantage retirement accounts where the amount contributed each year is based on a formula outlined in the plan. The benefits a participant receives depend on the contributions made in the investment performance. So how much someone receives depends on how much was paid in and the investment. How much someone received in a defined benefit plan has nothing to do with the underlying investment performance. So for this example, John contributes to a defined contribution plan where his employer matches a percentage of his contributions, and his retirement benefits will depend on the total amount contributed and the return on his investments. Okay? So on the defined contribution plan, however much he gets depends on what he pays in and the performance, and if the employer matches any. ERISA, E-R-I-S-A. So this is the Employee Retirement Income Security Act of 1974. This is a federal law that establishes minimum guidelines for most pension and health insurance plans established voluntarily by private industry, aiming to protect individuals in these plans. Example, John's company offers a pension plan governed by the Employee Retirement Income Security Act, ERISA. Under ERISA, John's plan must meet certain standards, such as providing clear information about the plan's features, funding, and his rights as a participant. This law ensures that John's pension is protected and that the plan is managed in his best interest with safeguards against his management and abuse. So in ERISA, essentially, there was rules and laws that were developed to help protect people against the plans that their companies came up with, the companies they work for came up with. Typically, these retirement plans, guys, these are very confusing. At least they were for me. They may not be for you, but when I was studying, they were confusing. This is such a small portion of most of the exams. I wouldn't stress about it crazy. But obviously, the more you know, the better you're going to do. KEO plans. KEO plans are retirement savings plans designed for self-employed individuals. They offer favorable tax treatment for contributions under the KEO Act, H.R. 10. Example, as a self-employed consultant, David sets up a KEO plan to save for retirement. He contributes a portion of his income each year, taking advantage of the favorable tax treatment allowed under the Keogh Act. His contributions are tax deferred, meaning he won't pay taxes on the money until he withdraws it during retirement. This plan helps David build a substantial retirement fund while reducing his taxable income during his working years. So essentially, you can put money in a lot of these tax benefit accounts. You can put money away, not pay tax on that money right now. It lowers your taxable income. The money grows and you don't have to pay tax on it. And then you pay tax on it when you withdraw it later. Okay, you pay tax on each payment as income. It's taxed as income. But you can't take withdrawals before age 59 and a half, or you have to pay an extra penalty, which is a non-qualified withdrawal. A non-qualified withdrawal occurs, well, you can take withdrawals, but it has to be qualified. There's only a few circumstances where you can do that, and that's in some other material that we have in some other courses. It might be in here too, I don't know. Non-qualified withdrawal. A non-qualified withdrawal occurs when money is taken from a retirement account without meeting the specified criteria, and the amount withdrawn exceeds the total contributions made. The earnings portion of the withdrawal becomes taxable. Example, if Lisa withdraws funds from a retirement account before age 59 and a half, and the amount includes earnings beyond her contributions, she will face taxes on those earnings as a non-qualified withdrawal. Profit sharing plan. So essentially a non-qualified withdrawal, she can't take out money before 59 and a half unless it's for certain things. Okay, there's certain rules on that. Profit sharing plans. Profit sharing plans are arrangements where a company sets aside a portion of its profits to be distributed among eligible employees. Example, at XYZ Corporation, employees benefit from a profit sharing plan where a percentage of the company's annual profits is allocated to their retirement accounts. So in a profit sharing plan, a percentage of the profit is put in their retirement accounts. I wonder if a 401k could be a profit sharing plan. Let me see. Yeah, it is. A 401k is a feature of a qualified profit sharing plan. So some of the profit can be contributed in a 401k by the employer's profits. The employer can match it up to a certain percent. Qualified plan. A qualified plan is an employer established, hit my camera there. An employer established retirement or compensation plan that follows specific IRS guidelines, allowing it to receive favorable tax benefits. So a qualified plan, once again, is an employer-established retirement or compensation plan that follows specific IRS guidelines, allowing it to receive favorable tax benefits. So it's a plan that follows certain things where there's tax treatment. Example, Jane's employer offers a qualified retirement plan that meets IRS regulations, allowing both her contributions and the employer's matching contributions to grow tax-deferred until retirement. Qualified withdrawals. Tax-free earnings distributions from a Roth IRA are possible through qualified withdrawals. To qualify, the account must have been held for at least 5 years, and the withdrawal must be to qualify as a qualified, it doesn't just have to be Roth IRA, but it can be any qualified plan. The withdrawal must be made in the event of a permanent disability, made by a beneficiary after the account holder has passed away, or used for a first-time home purchase or building or rebuilding a home, up to $10,000. Right? So tax-free earnings distributions from a, qualified plan are possible through qualified withdrawals. Okay, there we go. Okay, next, rollovers. Example here. Example of a qualified withdrawal. After holding her Roth IRA for 5 years, Emily withdrew funds tax-free to help with the down payment on her first home. Rollovers. A rollover involves transferring funds from an existing IRA or qualified retirement plan into a new individual retirement account. Example, When John left his job, he rolled over his 401k into a traditional IRA to keep his retirement savings growing tax deferred. So you can roll one into another. If you leave a job, you have a 401k, you can roll it into an IRA if you want and not have to pay taxes on the money you roll over. Okay. Roth IRA. So a Roth IRA is an individual retirement account that allows contributions with after-tax income. Contributions grow tax-free, and withdrawals made after 59 and a half are also tax-free. So in a Roth IRA, you pay tax on the money and then you pay into it. On a traditional IRA, you put money in before you pay tax. So let me show you an example. So if we have Roth versus traditional, okay? Say someone who makes 100K, okay? $100,000. Let's say they have $80,000 after taxes. Then they put $5,000 in. That money grows tax deferred, and then when they take withdrawals, they don't have to pay tax. On this one, they have the whole $100,000 in the traditional. They have the whole 100K. They put in 5K. They only pay tax on 95K. Okay. And then this grows tax deferred, and at the end, they pay tax on the withdrawals. So Roth IRA, you pay taxes first and you don't pay taxes later. Traditional IRA, you don't pay taxes now and you pay taxes later. So Roth IRA, you pay tax now, and you don't pay tax later. Traditional IRA, you don't pay tax now and then you pay taxes later. Okay. Savings Incentive Match Plan for Employees. A simple plan stands for Savings Incentive Match Plan for Employees. Simple, S-I-M-P-L-E. A simple plan or savings incentive match plan for employees is a qualified retirement option that allows small businesses to create tax beneficial savings plans for their employees. Example, Emily owns a small business and sets up a simple plan for her employees to help them save for retirement. Under the plan, employees can contribute a portion of their salary, and Emily matches their contributions up to a certain percentage. Both the employee contributions and Emily's matching contributions grow tax deferred, allowing her employees to benefit from tax savings while building their retirement funds. So this is for small businesses, and this lets small business employees contribute part of their salary, and then the employer can match the contribution up to a certain percent. Okay. So Simplified Employee Pension, SEP. A simplified employee pension is a qualified retirement plan where the employer makes contributions to individual retirement accounts established and controlled by the employees. So this is usually what I've seen people do this. They only do this if they're self-employed. But yeah, where it's just has higher limits. So these are typically for self-employed individuals. So you work for yourself, much higher limits than traditional IRA. And this just lets business owners put a big chunk of money aside to save for retirement. And then traditional IRA. A traditional IRA is a qualified retirement account that allows individuals to grow tax-deferred income annually with contribution limits based on their tax bracket. So traditional IRA, you put money before tax and then you pay tax later. I'm just going to look up limit on SEP IRA. This is in 2024 I'm making this. So right now a SEP IRA annual contribution is $69,000. And then I'll look for traditional IRA limit 2024. It's $7,000 or $8,000 if you're 50 or older. So SEP IRA's max is $59,000 or $69,000, sorry, in 2024. A traditional IRA is $7,000. All right, so appreciate that. Just did a marathon of vocab words. I hope this helps you. This is everything. This is pretty much all the vocab that you would encounter on your pre-license exam for your life insurance pre-license exam, or a lot of it for your life and health. I hope this helped you. Please, if you have any questions, send me an email, If you feel like you'd be interested in interviewing with me, send me an email. My email's in the description of the video. And if you want a copy of my free study guide, click on the link in the description of the video. My voice is gone. My voice hurts. And I'm excited to bring you guys this material. So I'm really excited to get this out to you. You're going to want to check out the other videos on my channel. You're going to want to pass your exam, and all get started on the next video coming up.